through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. And when you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every decision that I've made at this company is completely anathemic to what Bob did with his company. I want our writers to be partners. All of my senior people are locked into the company. They all have equity or they have a path to equity based on business results. That's something that we never had at Parker. Our benefits are world-class. And everything that we've done at Venice is completely different from that model. When Steve Tanzer, who is the most experienced active wine critic in America, wants to work with us, that says something. When Alessandro Masnaghetti, who's the best cartographer of vineyards, wants to work with us, that says something. When Neil Martin, who's a superstar wine critic with enormous experience in Bordeaux and Burgundy and the former lead critic at The Advocate, wants to come and be part of our team, that says something.
You make it sound like The Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great because I got to work with Bob Parker when he was at his prime, you know, and Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did, and should anyone's palate dominate it the way his did?
I just think the world is very different today. You know, I mean, it's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that one or two people will actually have more influence than Bob Parker did, because they will, again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, oh, well, nobody will ever beat this record. And then somebody comes along, you know, it's like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have two guys who are ahead of that and one knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. You know, that was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left The Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired his successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company, and that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, what we're trying to, we only hire superstars, and we're looking for those superstars.
In the world of professional wrestling, there's something called a swerve.
Hulk Hogan has betrayed WCW!
Some examples. These tag team partners are called babyfaces, or the good guys. Then one of them swerves when he super kicks his tag team partner in the head, quickly assuming the role of the bad guy, or what the wrestling world calls the heel.
Are you kidding? What a despicable act that was!
Or a match is almost lost when, what's that? The superstar wrestler appears out of nowhere sprinting down the aisle to save the match.
That's the Warriors music! It's the Ultimate Warrior!
That's a swerve. So it should go as no surprise that World Wrestling Entertainment, known as the WWE, the most popular brand of sports entertainment in the world, is prepared for any swerves that come their way. So here's the story of how the WWE learned to see the swerve coming. So I spoke to Bloomberg reporters Felix Gillette.
I'm a writer for Bloomberg News for the global business team.
And Kim Basine.
And I'm the U.S. luxury reporter at Bloomberg.
To find out exactly how the WWE is positioning itself for an all-out global invasion, which starts with a massive change to their lucrative pay-per-view model.
WWE basically pioneered the pay-per-view model on cable. I remember as a kid, when the pay-per-view events came up, all of our friends would scramble around and try and get one of the parents to pay for it.
But in 2014, they took a huge risk.
They saw a little bit sooner than some of the other entertainment brands that where this whole thing was moving was away from cable and satellite television and towards on-demand streaming video apps. They made this risky decision, in essence, cannibalizing that pay-per-view model, which they had essentially built.
And after some early turbulence, it's working. Roughly 1.5 million people are paying $9.99 a month for the WWE app, making it the 5th most popular streaming OTT service. This adapt-or-die approach is in the WWE's DNA. Over the past 30 years, the company always seems to think 2 steps ahead. In the early 90s,
WWE was at its most threatened when Ted Turner took them on with WCW,
which stands for World Championship Wrestling. And back then, the WCW was winning the ratings war. So in order to compete with them,
WWE had changed its product from a family-friendly kind of cartoonish style to this really raw. That's why they called their show Raw. It was this raw style of wrestling.
With violent, outrageous, reality-inspired plot lines and aggressive personas.
From a 16-foot ladder!
And they won that fight against Ted Turner. And they bought WCW.
The early 2000s ushered in an era of testosterone-driven programming aimed at the red-blooded American male.
Bra and panties matches, and people smash each other over their head with like barbed wire bats and things like that.
Until 2015, when WWE fans started a hashtag Give Divas a Chance. Since then, WWE has hired 40 more female wrestlers, and that growing cast of female characters was part of a much larger plan.
They started to try to appeal to a broader set of people.
Let's attract more female fans. And after we've attracted more female fans, let's attract more international fans. They're broadening their base, and they're doing that in large part to make it more advertising friendly.
And not just friendly to advertisers.
They're trying to build up their fan base in China. They're trying to build up their fan base in Europe. They, already have a pretty good fan base in India.
India is a place where they already have an established wrestling culture.
Because of the gigantic Indian wrestler, the Great Khali. But there's still a lot of work to do. While the WWE set a revenue record in 2017, only 30% of it is coming from an overseas audience. And there's one person whose responsibility is to grow that number.
The buck eventually stops at Vince McMahon, no matter what's happening within WWE.
Yeah, he's a very controlling guy, and it's a very, very, very tightly scripted company.
And that goes all the way down the board to big stars' entrance music and their outfits and things like that.
So with a CEO like McMahon always planning 2 moves ahead and an aggressive push into multiple international markets, a big issue is money.
It's hard to do all those things simultaneously without committing a huge amount of capital to it.
And that's where the WWE becomes an attractive company for buyers.
Potentially, one thing that could happen with WWE is they could benefit by being acquired by a bigger technology or telecom company, an Amazon or Facebook Facebook or a 21st Century Fox.
So with a market cap of $2.8 billion, the advantage of owning 100% of their own content, and a rapid consolidation spreading throughout the entertainment industry, it looks like the WWE is well positioned, even if there are swerves.
Our world is changing. Every day, it changes a little faster. Some changes are too small to see. Others, too big to handle. Sometimes, change feels slow. So slow, we don't even notice. Other times, it happens all at once, and we can't keep up. For our climate, change means many things. And between too small to see and too big to handle, there is a whole world of difference. The clock is ticking. This is Bloomberg Green.
Saving the seas. This week, the deep-sea diver who stopped writing the ocean's obituary to find a solution. Enric Sala tells us why the next 10 years matter most. And globalization needs to get greener. Shipping accounts for nearly an eighth of all transport emissions. How can the industry clean up its act? Plus, protecting coastlines comes at a huge environmental cost. But one Israeli startup found a way to keep the sea out and the animals in. From London, I'm Anne-Marie Hordern, and this is Bloomberg Green. After more than a decade of studying the ocean as an academic, Enric Sala realized he was writing the ocean's obituary. He quit his job and became a full-time conservationist. As an in-house explorer for National Geographic, he's clocked more than 5,000 open water dives. He's also founded Pristine Seas, a project that combines exploration, research, and media to lobby countries to protect their oceans. To date, it has helped create marine reserves equivalent to half the size of Canada. I spoke to him about his mission and why it's so urgent.
The state of the world's oceans is really bad. We have lost 90% of the large fish in the ocean. Sharks, groupers, cod, tuna. More than half of the fish stocks are overfished, which means that we are taking them out of the water faster than they can reproduce. More than half of the ocean is affected by industrial fishing, and global warming is killing coral reefs all around the world. The ocean is in a trajectory of decline.
Can you just visualize for our viewers who never get to see the kind of things you are able to see, what an ocean and healthy ecosystem looks like versus one that's next to a bustling economic and industrialized area?
Coral reefs in the United States, in the Florida Keys, are down to only 2% of what they used to be. Before, 80 to 90% of the bottom on a coral reef in the Caribbean was covered by live coral. Now, Florida Keys have only 2%. The average in the Caribbean is about 5% of the bottom covered by live coral. The rest is covered by slime and seaweed. And most of the fish you can see are this big. And it is very, very rare that if you jump into any place in the Caribbean at random, you see a shark. It's very, very rare. Now, let's go to Millennium Atoll, for example. An atoll that is uninhabited and fished south of the equator in the Central Pacific, belongs to the Republic of Kiribati. 2009, we conducted the first underwater expedition to this island, and I still remember the first time. Jumped over the side of the boat, and as soon as the bubbles cleared, I was surrounded by 15 gray reef sharks. After a couple minutes, the sharks decided that we were boring, and they went back to do their thing. And you look down, 90% of the seafloor is covered by thriving coral, and it's full of fish, and a sea turtle comes by. Now, this abundance that we rarely see anywhere except in well-managed marine reserves. This is what the ocean used to be like, and this is what we have learned from going to these pristine places.
And you write in your book that you're writing the obituary of ocean life. What's the cure?
The cure is doing less harm. Basically, there are three things that we are doing to the ocean. One is we are taking fish out of the water faster than they can reproduce. Two, we are turning the ocean warmer and more acidic because of man-made climate change. And three, we are throwing in everything that we don't want, our waste and our plastic. We need basically to reverse these trends.
Does this mean that a lot of this falls to governments and their policies?
That's a big part of it, because it is governments that regulate fishing and mineral extraction and oil extraction. It it is governments that have the legal authority to create large marine reserves in the ocean, but also local communities. We are not talking about something that is apart from us. We are not apart from nature. We are a part of nature. So these 10 years are probably the most critical in the history of humanity.
The most accurate measurements of changing oceans will come from space. While Enric Sala explores what lies beneath, a new satellite is giving us data from above.
We'll learn more about our oceans and climate change, but from space. A new satellite's been launched from California. Its mission, track the accelerating rise of sea levels.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise.
Data gathered from Sentinel-6 will be used alongside information from other satellites to build as complete a picture of the oceans as possible.
With a long record, we can precisely measure the acceleration. We eventually can detect new regime, tipping points. For example, if there is a runaway in the melting of Greenland or Antarctica, sea level will record this runaway change because it is an integrator of all changes that are occurring in the climate system. So we will be able to see some change, big change in the global climate.
The National Oceanic and Atmospheric Administration expects that sea level rise will increasingly threaten U.S. coastlines. One example, the southern tip of Manhattan is expected to flood 20 to 40 times a year by 2030.
11 of the 15 largest megacities are located at the coast, and this number will double. The number of people living in coastal area will double by 2060. So, knowing how much sea level is rising at the coast and how much it will rise in the future in coastal areas is as obvious. It's obviously a major goal for human beings.
Coming up, from sails to steam to oil, the shipping industry is no stranger to change. But how will it navigate the next transition? This is Bloomberg Green. From Bloomberg's European headquarters in London, I'm Anne-Marie Hordern. This is Bloomberg Green. Now, for your roundup of this week's latest climate news, Jennifer Zabazaja has your Green in Brief.
Here's the climate news you need to know. Deforestation of the world's largest rainforest has hit a 12-year high. More than 4,000 square miles of the Amazon rainforest was destroyed in 2020. That's a 9.5% increase from a year earlier. Government data shows that destruction has soared since President Jair Bolsonaro took office and weakened environmental enforcement. The Amazon is home to millions of species and plants and is critical in the fight against climate change. Bitcoin is hitting all-time highs, but at what cost to the environment? The cryptocurrency is energy intensive, and there are concerns if it becomes mainstream. According to MIT, back in 2018, Bitcoin's carbon footprint was almost as big as Portugal's. Want to get better at tackling climate change? We'll hire more women. That's according to Bloomberg New Energy Finance. Firms with 30% or more women in top jobs tend to perform better when it comes to the environment and are more likely to set clear climate goals. Shopping online is more popular than ever now, but the price of convenience is measured in CO2, and more deliveries means more fuel burned and more packaging wasted. So what can companies do? Well, many are becoming more efficient and sourcing more clean energy for their data centers and warehouses. And England's farmers will be paid to go green after Brexit. As European subsidies are phased out, they'll get new money to encourage them to produce healthy, sustainable food. Poor farming practices are one of the leading drivers of water pollution and the loss of biodiversity. I'm Jennifer Zabazaja in New York. Anne-Marie, back to you.
The shipping industry is more than just the grease on the wheels of globalization. It's its chief enabler. 11 billion tons of goods are transported by ship each year, the biggest contributors being 2 billion tons of oil, 1 billion tons of iron ore, and 350 million tons of grain. According to the International Chamber of Shipping, 80% of Europe's imports and exports happen over the seas. And for such a vast industry, it also contributes its fair share of emissions. Shipping makes up 12% of global transport energy consumption. So how does it clean up its act? Earlier, I caught up with Bloomberg Green reporter Laura Milan about just how big of a challenge this is going to be for the industry.
One of the main issues is size. So about 90% of the world's cargo is moved by ships. So obviously changing such a huge industry is not going to be fast, and it's not going to be easy. The second issue has to do with technology. So ships obviously travel for many days at sea. It's not as easy for them to refuel as it would be for a car, for example, going on a road. And the sector still hasn't found a technology that's economically viable and that's zero emissions, and equivalent to the electric batteries for cars, for example.
But actions are being put in place to make the industry a bit more environmentally friendly. Walk us through those steps that they're taking.
That's it. So there's a first step that would involve using low emission fuels or biofuels that would significantly reduce the existing emissions. And then at a regulatory level, when it comes to the policy and the governments, there are steps being made as well. I would say that the most significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
The concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, e-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism dies, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
This is markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got the Dow now lower, declining since our last update. The S&P, NASDAQ, they are both advancing. Tech shares are rallying amid lower Treasury yields after data showed inflation is running hot, lifted companies seen as better equipped to pass on higher costs to consumers without harming their businesses. S&P 500 moving higher after dropping earlier in the session. Tech-heavy NASDAQ 100 outperforming major equity benchmarks. Giants like Amazon, Microsoft also moving higher. Amazon, for example, up now by 1%. Microsoft shares, they're up by 0.7%. Here's where equity markets stand. S&P up 12, up 0.3. NASDAQ up 93, up 0.6. And the Dow Jones Industrial Average lower by 14, down 0.1. 10-year yield right now, 1.54%. J.P. Morgan Chase's dealmakers posted their best quarter yet, riding what's on track to be a record year for mergers and acquisitions. Allison Williams is a senior bank analyst with Bloomberg Intelligence.
The two big surprises that we got this quarter are similar to the drivers of positive surprises in recent quarters, and that's the investment bank and the reserve releases. So the reserve releases are something that really helps the bottom line this year. Hurt the bottom line last year, and so obviously that's something that's not sustainable. The global investment bank continues to surprise to the upside this quarter. It's really equities, trading revenue growth very strong, advisory fees a new record.
JP Morgan Chase shares, they are trading lower after that report, down 2.5%. Citigroup reports tomorrow. Citigroup shares down 0.5. Wells Fargo, Bank of America also on tomorrow. Wells Fargo down 1%. Bank of America down 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, streaming on YouTube, it is a Fed Wednesday, October 13th, 2021.
Focus on the Fed is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more.
Fed Wednesday, and that's because FOMC minutes are being released. That's from the September 21st, 22nd meeting, and already our live blog is on it. It says that there was a difference of views on whether the substantial further progress test toward maximum employment had been met. Many thought the progress test would be met soon. A number of participants assessed that the standard of substantial further progress toward the goal of maximum employment had not yet been attained, but that if the economy proceeded roughly as they anticipated, it may soon be reached. That is straight from the Fed minutes. We're going to break it down in just a moment. That's coming up. Also, live long and prosper.
Yeah, William Shatner. In a world, though, where inflation continues to prosper, on our radar is William Shatner. And, of course, him coming out of the Blue Origin capsule earlier today.
Yeah, exactly. Everybody was glued to it. Speaking of prospering inflation, we'll talk about the latest inflation numbers on the context or with the context of those Fed minutes in just a moment. We have JP Morgan earnings. We have the cover story of Business Week. It's all about Citigroup's Jane Fraser.
Yeah, she's looking to do things differently. It's our cover story. Jenny Serrain is going to be joining us. Also, the band of Wall Street renegades that invented the index fund and changed finance forever. A new book by Robin Wigglesworth. We're having him on the show.
Yeah, and we're not done with the Apple supply chain problems. We're going to dig into that. Let's, though, get to those Fed minutes and the market drivers report. Let's set the Business Week agenda on this Fed Wednesday. Kathleen Hayes, a special visit because of this FOMC minute. She is Global Economics and Policy Editor at Bloomberg News in our Interactive Broker studio, along with Dave Wilson. He is, Dave, of course, Stocks Editor at Bloomberg News. Kathleen, though, take it away. What are the headlines that we need to know out of those September meeting minutes?
Well, certainly that the FOMC minutes suggest that they were saying the taper could start in mid-November or mid-December, underscoring this expectation that on November 3rd, at that FOMC meeting, there'll be something in their policy statement and more in Jay Powell's post-meeting press conference suggesting, well, maybe even giving us a date. I think that will be very interesting because some people think, well, no, they have to have a meeting.
Don't we know already because they said they're going to be done by next summer?
Good for you, because that's also what the minutes suggest, that they could be done by around mid-22. I think, Carol, that's clear that's one of the reasons why they want to start now. Inflation is high. Half of them at least expect it to be transitory, but what if it's not?
Right.
Then it'll be much better to be done by mid-2022, so by shortly after that, if you want to, you can do that first rate hike. And remember, when we got the last dots in June, half of the FOMC dots were looking for the liftoff in 2022. Some people even looking for 2 hikes next year. So this all fits together.
Well, just one other headline from our live blog, and this, as our Chris Anstey, senior editor, says, this is the 2023 rate hike crowd. Various participants stressed that economic conditions were likely to justify keeping the rate at or near its lower bound over the next couple of years.
Hey, Dave Wilson, come on in here and give us the equity market reaction to all this.
Well, in short, positive. I mean, you saw the S&P 500 reach its high of the day. Once the minutes came out, it's kind of given back that gain. Still, though, shares up on the day, and the market has managed to overcome some disappointments when it comes to earnings. I mean, J.P. Morgan Chase down more than 2.5% after its results came out, and Delta Airlines down more than 5.5%. Now, they were profitable in their latest quarter, first time since the pandemic began. When you take government aid out of the picture, problem is they're figuring they may have a loss this quarter because fuel prices are up, and of course that's a major expense for the airline. So you're seeing those stocks take a hit.
Yeah, Delta CEO Ed Bastian saying to Bloomberg News that fuel prices have risen 60% just this year.
Well, yeah, and that's a big thing when it comes to the airline. When you look at their cost balance sheet, that's a big one. I do want to say that the Fed staff raised the inflation forecast, still saw it, though, as transitory. But I do wonder, Kathleen, when it comes to transitory, and I've been reading a lot about this, that people are like, well, maybe transitory is just kind of long transitory, especially as long as the supply chain is still disrupted.
Well,
and
I think
people are still not maybe going back to work to help ease some of those constraints.
Two things we have to put together for me. Number one, if you're talking about just tapering, right, or even the need to lift the rate off zero, when you have inflation so high above its target and you don't know exactly when it's going to come down,
right?
When you know the economy is growing and jobs are growing in a step-by-step matter, supply of jobs is limited, so that's one reason why the jobs aren't growing faster, because a lot of people don't want to come back to work. What's the big deal about tapering the bond purchases? They were done at the beginning of a huge emergency. We had a terrible depression. It was a health crisis, not a financial crisis. And so, in fact, one of the headlines, some Fed officials saw bond buying as raising financial risk. So much liquidity, everyone thinks the Fed's going to support you forever.
Right.
Some people think this is risky. And even the IMF is warning about financial instability risk. So it seems to me that the step towards taper is easy. The step towards the first rate hike is harder, a lot because of the political pressures from Washington and progressives who don't want them to ever raise rates. I'm exaggerating. But so it's a lot for the Fed to deal with. I think they're definitely telling us they're going to taper, and they want to be done by the middle of next year.
10-year right now yielding 154. I'm looking at the 2-year note. It's got a yield of 0.35. So we're seeing it definitely off highs of what we saw earlier in the session. All right, Dave's going to be back later on with his chart of the day, continuing to track the stock market trade for us. Kathleen Hayes, thank you so much. Catch her on Bloomberg TV tonight on Daybreak Asia. Let's do the bite of the day.
It's one number that tells us a lot, and it's brought to you by GEP. GEP helps businesses transform supply chains with strategy, managed services, and AI-based cloud-native software. Learn more at GEP.com.
All right, Tim, so today's number, 400. According to a recent Bloomberg City Lab analysis of over 31,000 uniformed NYPD officers, 15% worked more than 400 hours each of overtime last year. Annual salaries started at about $42,500. Overtime, though, can help bump that up to over $100,000 a year. If you've ever seen a Law and Order episode, I feel like that has come into like
it's all about that overtime, especially toward the end of the career.
A storyline at some point. That near $11 billion spent on policing, $11 billion. That should have been the bite of the day. When overtime, pension benefits, and capital spending are factored in, it kind of cold comfort to New Yorkers who are rattled by a number of high-profile shootings, Times Square and other places. A lot of murders we've seen in the city.
Yeah, about 470 in 2020, up from nearly 320 the year before.
There's another number, another bite. Aye.
A lot of bites in there.
All right, let's bite this, basically. All right, let's get to world and national news. Over to Nancy Lyons in D.C. A little bit of a wacky Fed Wednesday, Nancy.
Yeah, thanks, Carol. Well, history was made today when Star Trek's Captain Kirk, also known as actor William Shatner, made it into space at the age of 90. That makes him the oldest to ever go in space. He was one of the crew members in Blue Origin's New Shepard rocket that blasted off from a facility in West Texas, reaching more than 340,000 feet in altitude. Shatner expressed his glee as the capsule is returning to Earth.
How about that, guys? That was unlike anything they described.
Shatner described the flight on Blue Origin's live stream as the most profound and moving experience of his life. It was Blue Origin's second passenger flight. President Biden is meeting this afternoon with key stakeholders in the nation's supply chain. The Port of Los Angeles is expanding operations to 24 hours a day, 7 days a week, to deal with the backlogs. Bloomberg's Washington correspondent Joe Matthew has more on who's at the White House for these discussions.
We're going to be hearing from the CEOs of FedEx, from UPS, also Target and Walmart, who are going to help pick up some of that massive backlog that could be left. The White House says roughly 3,500 containers will be moving at night now once we get up to speed here through the end of this year.
You can hear more from Bloomberg's Joe Matthew this afternoon at 5 p.m. Wall Street time on Bloomberg Sound On. There's new guidance from the FDA regarding salt in food. This comes amid a rise of diet-related illnesses. The agency wants to see Americans reduce their average daily sodium intake by 12% over the next 2.5 years. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All All right, Nance, thank you so much. Carol Massler, Tim Stanovic in our Interactive Broker studio. Gotta say, I was glued to watching Blue Origin go up into space.
Yeah, it's considered space,
right?
fair. Yeah, call it space, Carol.
All
it's
right,
above the Kármán line.
All right, Jeff Bezos. So going up into space, then coming back with none other than William Shatner. I got to say, our Alex Steele on TV really said, and some others, that he really got emotional, I think, when he came out of that rocket. First of all, let's play a little bit more of sound. You heard some from Nancy Lyons, but here's a little bit more of Captain Kirk.
What you have given me is the most profound experience I can imagine. I'm so filled with emotion about what just happened. It's extraordinary.
None other than William Shatner. He went up in an 11-minute trip into space on board Jeff Bezos' Blue Origin rocket. That was when he was talking to Jeff just after he landed back on Earth. And they did, of course, touch down safely in West Texas. You've been there.
I've been there, yeah. This was a
know.
big deal, not as big of a deal as when Jeff Bezos went up there in the middle of July.
Yeah.
Because that was the first actual manned flight.
Right.
But this shows that Blue Origin can do this repeatedly. They've actually done another flight since then. That one didn't have any people on it. But William Shatner, we were covering it live on Quick Take too, Carol.
Yeah.
And he was speechless.
He was.
When
He
he
was
exited
emotional.
that pod.
Because we were all saying, oh, is he going to give the Vulcan sign? Is he going to
Yeah.
do something fun? And you could tell that the gravity of the moment was certainly with him. You really saw that. And like I said, I think our TV crew and really caught it because they were breaking it down too, that he was emotional at it. And it's, I was watching too and kind of getting emotional, having had a father very involved in space race. But I love that we're all watching and kind of cheering it on because there got to a point where people were like didn't even care about space exploration.
It's what you hear over and over again from the very few people who've actually gotten to experience this. What they see when they're up there just changes their entire perspective of living on this planet.
Right? And Earth and a vast universe. Can you do the Vulcan sign now? That's what we want to know.
Live long. I can.
Tim and I
did
can.
It. Yeah.
It's on YouTube. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The latest Fed minutes are out. Federal Reserve officials broadly agreed last month that they should start reducing emergency pandemic support for the economy in mid-November or mid-December, even as the Delta variant continued to create headwinds. Stocks trading higher right now. We have got the S&P up 13, up by about 0.3%. The Dow up 5, little changed, up less than 0.1%. NASDAQ up 94, higher by 0.7%. 10-year up 9/32, 10-year yield 1.54%. Spot gold up 1.8%, $17.91 the ounce. And West Texas Intermediate crude down 0.1%, $80.59 a barrel. Tech shares climbed amid lower Treasury yields after data showed inflation is running hot, lifted companies seen as better equipped to pass on higher costs to consumers without harming their businesses. Earnings this morning from J.P. Morgan Chase, shares lower now by 2.6%. Also reporting earnings this morning, we did hear from Delta Airlines. Delta tumbling now by 6.1%. Recapping 10-year yield 1.54%. S&P up 14, up 0.3. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, of course, breaking down the trade. Charlie Pellet, thank you so much. Talking about those big banks, too, and just to rehash, J.P. Morgan really one of the ones we've obviously been front and center today, down 2.6%. So it's hovering near its lows of the session. And this is after I think it's safe to say, Tim, the most closely watched bank and certainly the most closely watched CEO of a bank on Wall Street, they did come out and they said it was a record in terms of making deals, a record M&A quarter, and that's happening in the industry more broadly, kind of record M&A activity. But that certainly offsets some of maybe the downside of what we saw for J.P. Morgan.
But not enough for investors today. Loan growth still lacking. The bank does see some green shoots. The company's CFO emphasized that excess deposits are stabling. Analysts, though, on the call, they were quite curious how the bank intends to deploy its capital. What's its acquisition strategy with all these fintech players that are out there right now?
So she has been so busy, so just coming into the studio because she has been nonstop and probably up since the wee hours. Allison Williams, our senior global banks analyst at Bloomberg Intelligence, here in our interactive broker studio. Thanks, because I know it is a crazy day for you.
Did you get in at like 4 a.m.?
Yes, I did, but this is just the warm-up. Tomorrow we have 4.
I was just going to say. All right,
today's sort of relaxed, and we actually have had time to go through the numbers and such, and I think you touch on a couple of key points, and really our takeaway is, green shoots need to blossom. So
right. Will they blossom?
So there's a couple of positive signs. So the consumers are working down the excess deposits. So one of the reasons why we don't have card loan growth is because people are paying off their cards with their savings. So they're spending, but they're not borrowing. So that's why those excess deposits coming down are sort of a sign of a green shoot for the future.
How important is that as a revenue line for these companies?
So for J.P. Morgan and Citi, it's relatively important because they have more exposure to the card business. If you think about the yields on a card loan, the spreads are much better than some of the other businesses. And then the other area, sorry, I'm just going to move my mouse.
She's got a mask on, she's got headphones. It's not easy.
You got to wear a mask around.
So
the badge gets
following the rules. So so the other positive is that they're seeing an uptick in commercial line utilization. So that's an important read across for Wells Fargo and Bank of America tomorrow. Mean? So what that means is, banks extend credit lines. Mm-hmm. During the crisis, we saw people borrowing on those lines, right? So think of it, people have like a home equity line of credit or any kind of letter of credit. This is available to you. And so banks or companies pulled down, they borrowed, then they paid it all back. And so use of those lines is very low because, again, the companies, like consumers, have a lot of cash. Mm-hmm. And so they're not borrowing. And so to the extent that you're starting to see companies use those lines, right? So they're starting to borrow against them, perhaps to finance inventory needs or other.
Wait a second. I thought the housing market was on fire and everybody's getting new mortgages at low rates and they're going out and buying really expensive homes because the monthly costs are low.
That is, and that's all good for origination volumes, but it doesn't necessarily transfer to loan growth because a lot of the banks sell off those loans. So it's good for volumes, it's good for fees. But by the way, we're starting to get up some tough comparisons in those businesses. So
it is interesting on the commercial side, though, that if they are drawing on the lines finally, right? Because we've seen such a huge cap raise. Certainly during the pandemic, right? Everybody was able to, because money was so cheap.
Correct. So we've seen, massive raising of money by corporations. And what's interesting that we saw in the quarter was actually still some good debt fee growth because now with all this M&A going on, people are borrowing with those transactions. So there was actually some debt fee growth. Advisory, I think, as you pointed out earlier, that's really the highlight. Record fees, triple a year ago for J.P. Morgan. Up like a big percent, I think is like 50% from the prior quarter.
Hey, listen, also what's always a highlight, I feel like, is, the results. And let's point out, J.P. Morgan has been on a tear, up about 27% this year. So it's been a big bump to the upside. We've seen that with some of the big banks. What Jamie Dimon has to say about the world at large, I have to say, we're getting ready to go to Milken, and I was taking notes for some of the interviews and some of the panels we're going to be doing because he's like, I'm going to spend whatever I have to on fintech. And I was thinking
that was really the big. I think that was a really big line, and I think that's the other thing that you've seen in J.P. Morgan's numbers. I mean, they raised their cost guidance something like 5 times, $5 billion, like over the past year.
Yeah,
and we think that spending is going to go up next year. But I think just him, sort of making that statement, we have all kinds of competition. We're going to spend what it takes.
Yeah.
So sort of a mic drop, as my peer put it.
Yeah. Wait, spend what it takes to compete or spend what it takes to acquire?
Well, you can compete by acquiring, right?
Check.
So one of the things that the banks have done, or I guess two of the things that they've done, right, is that they they partners with fintechs, they buy the fintechs, they have these venture funds where they do different things. So I think they kind of look at it from all angles, and what we've talked about is this go round, right? So in the 90s when there was the internet and they all kind of dismissed it, this time around the banks from the beginning, even with technologies like blockchain, we're going to make sure that we're involved.
Except for Bitcoin. We know how he feels about
Bitcoin,
right?
Yeah, a little bit more controversial on Bitcoin.
Real quickly, I'm going to squeeze you 25 seconds. What we've got: Citi, Wells, Morgan Stanley tomorrow. What am I leaving out?
Bank of America.
Goldman Sachs tomorrow, Bank of America. I think Morgan Stanley's on Friday, but
forgive me. Yeah,
strong equities trading, M&A fees strong. Still looking for some more signs of green shoots on the loan growth side.
All right, sorry, you'll get sleep on the weekend or somewhere. Allison Williams, we love her. Knows this industry like no other. She's senior global banks analyst here at Bloomberg Intelligence. We are lucky she's part of our team. You are listening to Bloomberg Business Week. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Right, it is Bloomberg Business Week. It is Wednesday. What?
Don't put a dollar in the jar.
For every time you say transitory?
Every time you say transitory. Raphael Bostic.
Yeah, don't
the
buy
Atlanta
Bitcoin.
Fed.
Just put a dollar in the floor every time you say transitory. And you'll be
That was funny.
You'll be rich. Hey, we're going to talk about inflation, transitory or not. Bloomberg's Cameron Cries. He's just a treasure here, and he's going to join us in just a moment.
In the meantime, let's get a check of the trading day. Here's Charlie Pellet.
Thank you very much. And here's what's going on. Traders are assessing minutes of the Fed's latest policy meeting. Officials broadly agreeing they should start reducing pandemic stimulus in mid-November or mid-December. Choppy session. We've got the Dow swinging between gains and losses. Right now, the Dow is down 7 points. Key takeaway, little changed. S&P doing a little bit better, up 10, up 0.2%. The outperformer today, tech stocks. NASDAQ Composite Index up 87 points, up 0.6%. NASDAQ 100 Index up now by 0.7%. The 10-year yield, 1.54%, 10-year up 8/30 seconds. Spot gold up 1.8%, 17.91 the ounce. Bitcoin surging 2.8%. 56,922 on Bitcoin. West Texas Intermediate crude down 0.2%, 80.50 for a barrel of WTI. A federal judge has barred United Airlines from placing unvaccinated workers with a religious or medical exemption on unpaid leave as part of its mandatory COVID-19 vaccination program for employees. One of the issues for medical experts battling COVID has been the concept of herd immunity, getting the population to a level of 70% vaccinated. Dr. Bhakti Hansadi is Associate Professor of Emergency Medicine at the Johns Hopkins Bloomberg School of Public Health.
There's a big variation across states, and there is a concern that we're not going to get to herd immunity, right, countrywide. And as long as pockets of vulnerabilities exist, there is an opportunity for various concerns to emerge. And so herd immunity is still like a long way off in that dialogue.
Dr. Bhakti Hansadi with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine names that we follow on a regular basis. Today we do have Pfizer shares. Right now Pfizer is down 1%. Its German partner BioNTech, the ADR is up 1.4%. AstraZeneca's ADR is up 0.5%. Moderna up 2.7%. Johnson & Johnson up now by 1.2%. Recapping, S&P up 7, up 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
You're kind of a treasure too, Charlie Pellet.
Transitory. Or
transitory treasure? All
No,
right.
you're
we go.
permanent.
Hey.
You're a permanent
It depends.
treasure.
It depends who's judging. That's how you define transitory.
Depends on the last report, right?
Exactly.
All right, Charlie Pellet, thank you so much. So he writes today on the Bloomberg that, quote, perhaps the most important outcome today is that there remains little sign that inflation is turning around. Let's get a market perspective on today's hotter than forecast CPI report. With us, Cameron Cries.
Cameron's macro strategist and a contributor to the Markets Live blog at Bloomberg News. He joins us on the phone from Westport, Connecticut. Macro man, literally. Macro man.
Yep, he is.
Cameron, take us into the reading of today's numbers. It came in a little hotter than expected, but only a little hotter.
Well, I guess it depends on how you want to define that. Yeah, I mean, the headline number came in at 0.4% on the month. The market had expected 0.3. The core reading, which is thought to give a better sense of underlying inflation, was 0.2, and that seems very well behaved. But there are a number of things under the surface that ebb and flow based on what's going on with the pandemic, say. But there are some alternative measures, such as those that sort of strip out the very lowest and the very highest readings, the so-called trim mean or median CPI. The Cleveland Fed has a series on that, and that actually rose by 0.45%, which is the highest in more than 30 years.
Wow.
And one of the highest readings in the last 40 years. So from that perspective, what that implies is actually that the the scope of price rises is broadening out, and it's not just a narrow set of components that are impacted by the pandemic that are seeing price rise. This is exactly what you would expect if inflation is not, in fact, a transitory phenomenon, but is starting to build on itself as the public gets used to this idea that the price of everything is going up.
Well, and you know what's interesting, Cameron, in prepping for this segment, I wrote to myself a little note. When I'm not speaking to myself, I write to myself. But when are we allowed to say that inflation isn't transitory anymore? Like, what is it technically that happens where we say, no, folks, this is the environment, and it's going to stay with us?
Well, between you and me, you can say it now. Okay. Go home, lock yourself in the bathroom, look yourself in the mirror, and say it loud, say it proud. It's one of these things. It seems like the only people that's not fair. But among the central bankers, the people in charge of policy, are the most prominent advocates of this notion that it's transitory because they kind of need an excuse to do nothing. You could argue that given what the stock market's done, given what spending has done, that we haven't needed emergency settings for monetary policy for quite some time, but yet we've been full bore QE, and sort of one of the excuses is that, well, all this inflation stuff that everyone's worried about, it's just transitory. It'll go away. And in practice, life is transitory. In the long run, we're all dead. And in between now and
economists
then,
in the past.
Hey, everybody, this is the Sunshine Report.
So at some level, geologic time, all human existence is transitory. Right? So it's an arbitrary construct that basically I think the central banks are using to mean until we're proven correct. But you are seeing some fractures in the committee. Some of the regional Fed presidents in particular have been pretty dismissive of this notion that you can just wave away price rises. And I would say that these are the people that are more in touch with sort of Main Street and the real world because they have business contacts they speak to on a regular basis.
Well, does it seem like from a policy perspective, the Fed is letting the Fed's letting stuff run too hot?
I think so. And I think one of the reasons is that over the last sort of 30, almost 40 years, inflation and policy has been thought of from the demand side. We need to manage demand to get the outcomes we want on inflation. The problem is that this inflation shock is driven not just by demand, but also prominently supply. The supply side, you've had these supply constraints because of the pandemic that aren't going away. And when you match that sort of reduction in the supply with outsized demand, last sort of 18 months or so, that's where you get this sort of dynamic. And the problem with the risk is if it becomes sufficiently entrenched, then that permanently changes, or maybe not permanently, but substantively changes expectations and behavior. And this is exactly the phenomenon that we had in the 1970s, where there was an energy supply shock that was met with policy that said, well, we're not going to address this sort of head on because it's going to be ephemeral, but it influenced people's expectations, their wage demand, and the next thing you know, you had this sort of wage price spiral where people got paid more and they were willing to pay more for goods and services. The price of those went up, the people demanded more wages, and that just kind of fed on itself. And there's a risk that we're going to see the same sort of thing materialize this time around.
Hey, when it comes to wages, and I was just looking at your work, I mean, you point out real wage growth is negative using both hourly and weekly earnings series. And funny enough, there's a prominent shortage of labor. Perhaps the public is sharper than we've been led to believe. Because one of the things I thought about, I don't know if the Fed is watching, because they talk about inequities, inequalities. Certainly the lower end of the income strata, has not seen the benefits that the higher end has seen, especially when it comes to wealth gains and wage gains. And so in a funny way, this shortage of labor has, drove companies to increase what they pay, certainly hourly workers. And in some way, is that a benefit? But help me out here. Is there real wage inflation? We keep hearing about it. How do you see it?
Well, this is the issue, right? yes, wage growth has been stronger than it has been historically. But if you get a 4% pay rise, but the cost of living goes up by 5%, are you better off? No. You can buy 1% less stuff. There's this phenomenon known as money illusion, which means that there has historically been a tendency to say, well, I've had a wage rise of 4%. This is fantastic. But if the public is now aware, because of this narrative of widespread inflation, that 4% wage growth isn't going to cover the cost of living, then there's a problem. And there's an argument that if people aren't compensated adequately, negative real wage growth is not a particularly remunerative compensation, then the marginal propensity to actually work and face exposure to COVID or what have you is less than if you have positive wage growth.
So, Cameron, here we are. Earnings season has kicked off officially. We heard from Delta, we heard from Fastenal earlier this week, and we heard, of course, from JP Morgan Chase earlier today. Delta saying that fuel prices have risen 60% this year. The company's saying that could really hurt what happens this quarter. What should we be on the lookout for when it comes to other companies that are reporting over the next few weeks when thinking about these pressures on the supply side and on the demand side?
Yeah, one word, margins. The big question is if input costs are going up in terms of raw materials or in terms of labor, companies have two choices. They can either raise prices and pass those costs on to somebody else, whether it's their business customers or their household customers, or they can absorb a hit to margins and essentially make less per dollar of goods and services that are sold. And in probability, it's some combination of the two. So I think the thing to focus on is to what degree are companies seeing a squeeze on margins, because that is obviously not a positive for the equity market.
Right, and that's when, if you're a publicly held market, you got to care, because if those margins start to diminish, go down, decline, you're going to get punished probably when it comes to your reporting season and certainly to the stock price. Hey, Cameron, thank you so much. Really some great insight into terms of some of that inflation data that we got today. Cameron Kreis, he's macro strategist. He's the macro man here at Bloomberg. He is a contributor to Markets Live blog at Bloomberg News, on the phone from Westport, Connecticut.
Well, let's get some more news and head down to Washington, D.C. for a check the latest world and national, where Nancy Lyons is standing by in the 99.1 newsroom. Hey, Nance.
Hey, Tim. The Biden administration is focused on relieving the supply chain bottlenecks at the nation's ports. One step that is being taken, the Port of Los Angeles will become a 24-hour, 7-day-a-week operation. This afternoon, President Biden is meeting with corporate executives, labor leaders, as well as port officials to discuss distribution backlogs. We're waiting to hear from the president. He's expected to speak in just minutes. Star Trek's Captain Kirk is now the oldest person to fly into space. 90-year-old actor William Shatner was aboard Blue Origin's New Shepard rocket as it blasted off this morning from Texas. He described the flight as the most profound and moving experience of his life.
I hope I never recover from this. I hope that I can maintain what I feel now. I don't want to lose it.
Shatner says it's something everyone needs to see. It was the second passenger flight for Blue Origin, which is owned by Amazon's Jeff Bezos. The FDA says Americans are eating way too much salt, about 50% more than recommended, and that's leading to additional illnesses. So FDA Commissioner Dr. Jeanette Woodcock says it's time to reduce our sodium intake.
We recognize this isn't a change that will happen overnight. It requires an iterative approach that supports gradual reduction in sodium levels broadly across the food supply over time.
Woodcock says the goal is for Americans to reduce their sodium intake to 3,000 milligrams a day over a 2.5-year period. She says that push will also include a campaign to reduce salt in foods prepared by restaurants, cafeterias, and food trucks. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Now back to you, Carol and Tim.
All right, Nance, thank you so much. Nancy Lyons in our DC Bureau. Well, here in our Interactive Broker studio, 2 days in a row, I'm going to just say that Tim and I are super, super lucky because Jenny Serrain, she's our finance reporter here at Bloomberg News. She's got the cover story of Bloomberg Business Week. This week, it's all about the relatively new CEO on Wall Street, not new to the company she now runs, but she certainly is making some changes when it comes to Citigroup. We're talking about CEO Jane Fraser. Jenny here in our studio. Congratulations.
Thank you.
Great cover story. First of all, tell us about writing this and kind of what you set out to do.
Yes, well, we set out to really tell the story of Citi right now, and we were fortunate enough to get an interview with Jane and have her kind of walk us through some of the big changes that she's got planned. They're just an interesting company. You know, they've had a really rough go of it recently, and I think they needed this fresh air and fresh blood, and they've got that, and so it'll be interesting to kind of see where she takes it from here.
Well, speaking of fresh air, I mean, the piece literally opens with fresh air, talking about an outdoor space that Citi has for employees, and also the way that Citi is different than the other majors in thinking about a return to work. Take us through what Jane Fraser is doing and why this is kind of crazy for what's happening on Wall Street.
Yeah, I think that's exactly right. So a lot of where this started was just we were hearing grumblings over and over again that people were leaving other banks and joining Citi simply because they really liked the way she talked about the future of work and what that looks like. And so, you know, she's doing the thing where they are allowed to work from home at least 2 days a week on a permanent basis. That's one thing. But I think the more interesting thing that she's said is it's not just about this hybrid half in, half out situation. They're also being really flexible. So, you know, if it's 3 o'clock and you want to knock off and go pick up your kids from school or take them to a soccer game, that's fine. You know, log on later and finish your work up whenever you can. It's this whole idea of flexibility that people seem to really appreciate. You know, she's acknowledging that people are not just robots at a desk, that they're real people with real lives and really embracing that.
All right, so don't penalize me because I really hate this. Is it because she's a woman that she looks at it differently? Because that kind of makes me crazy. But there is that. But is it also a leader who's understanding that the world has changed because of the pandemic, and we have shown, certainly the big banks, how much they could get done home? Is it also, third, kind of her sticking to the other banks and saying, you know, it's a fight for competition. And so if this is what we have to do to kind of draw in talent, this makes sense.
Yeah, I think she's definitely unique in that she seems more willing to listen to her employees and has kind of let that guide a lot of her decisions, you know, since becoming CEO. And also she was president before that. So I think she's very unique. A lot of the other CEOs kind of get an idea in their head and stick to it and don't really let a lot of advice come their way, but I think she's very unique in that sense. And I do think, you know, it's a war for talent right now. These banks it's a very cutthroat environment for bankers, for traders, for engineers, for all sorts of different folks. And she's acknowledging that, and I think really kind of setting them apart.
I thought of the other cover story that was on Business Week. I don't know, was it over the summer? Where it's like, basically, I don't get out of bed for $120,000 just to steal, you know, the supermodel line. But it was basically because we just continue to see, right, Tim, that Wall Street, the big banks, the big firms are upping kind of salaries for some of their, you know, starting junior bankers, whatever, you know, we just see that happening.
Well, when, Jenny, will we start to see this pay off? If there is this talent war, and we know this talent war is happening, when will we start to see the moves that Jane Fraser is making in terms of poaching talent and perhaps just as important, retaining talent?
Yeah, so that's the big question, I think, facing all of the efforts that they're making. They've already started to have some successes. There's been some big names that have left Goldman Sachs, JP Morgan, Google, and joined Jane in her big journey. And I think it's not just talent. You know, it's also this whole energy that she's trying to bring to the turnaround there and really just trying to set them apart and set them on this path towards excellence is the word that they like to use, which is all, you know, to be fair,
She did work for McKinsey.
She did work for McKinsey. She's
Sorry, love you, McKinsey, but you know, right?
She's definitely. I mean, she has that consultant brain, and you can kind of see a lot of that McKinsey touch in the strategy refresh that she's partaking, or that she's kind of venturing out on. So she's, you know, focused on wealth. She talks a lot about prioritizing high return businesses, deprioritizing the low return businesses. That's McKinsey.
Well, let's talk about it. I remember very early on in my career when Sandy Weil was at Citi, right? And he bought Smith Barney. He was making this financial supermarket company. And I remember under the red umbrella and like doing the whole thing, doing a stand-up. But what's interesting is wealth management, right? They lost Smith Barney eventually or sold it off. Is that an area they've got to be a bigger player in?
So Jane certainly thinks so. And I think, if you look at some of the big success stories on Wall Street of the last decade, it was wealth management shops. Morgan Stanley bought Smith Barney and has since turned it into this powerhouse. And so I think, it's definitely a high returning business. Citi has long, punched under their weight there. And so it's kind of an easy one where they already have a little bit of scale. They just got to invest and get it a little bit bigger. But
internally, or do they have to acquire? Or can they acquire? Is there anything out there?
They're a little bit hamstrung right now. They've, last year they had the OCC and the Fed ding them for some longstanding issues with their internal controls. And so they're really limited in the amount of M&A activity that they can do because of that. Everything has to be run by their regulators. So I think they're, really focused on an organic growth strategy with this. And yeah, wealth management, everybody's making lots of money there, so.
Okay, no, we already talked about work-life balance, but I'm stuck on this one quote that you include.
You do work-life, and I'll do the different parts of the business.
Because I was pretty surprised to read this when I was reading it this morning. She told you, quote, the number of dads that came up and said, it's so neat because I can work from home and therefore I can get to the kids' school play. First of all, she called out the dads, right? Which was, I think, huge as a dad. And two, this is not Wall Street, right? This is not the Wall Street that's portrayed by the media, and certainly not the one that's been portrayed over the last couple of years, as we've seen so much burnout.
Yeah, that's absolutely right. I mean, I think that's what is so fascinating, to cover with Citi right now, and the just totally different tone we get from them than a lot of their competitors. And so I think she really embraces, she's a mom herself. She embraces that side of her and talks about it openly and talks about, going part-time when she first had her kids as a partner at McKinsey. And I think she definitely brings all of herself to that role and encourages other people to do the same. And that's really what makes her kind of stand apart in a lot of these discussions. I feel like she brings a much more authentic and kind of genuine tone to it all. But, at the same time, she's got a really tough job. So I think a lot of it is, the communications and the approach, but then there's execution. And that's where we really have to see kind of going forward.
Well, execution is such a big thing. And again, going back to the pandemic, I think we were all shocked at how well things worked. And certainly the big banks, right? I mean, they did really, really well. Productivity returns as she continues to be really flexible. What is she seeing? What are they seeing in terms of Citi? And we'll get a read, right, in terms of earnings this week.
Yeah, so we have earnings tomorrow, so it'll be very interesting to kind of see how it all plays out. I mean, she said that they watch productivity very carefully, and none of what they've done so far has led anyone to slack off, and no one seems to be using the extra flexibility to not work. At the same time, their returns are much lower than a lot of their rivals, and
Why is that?
I mean, I think a lot of it is just that they had more catching up to do. They took the biggest bailout. They set aside nearly $1 trillion worth of bad, unwanted, toxic assets that they had to sell off.
From the crisis, from the financial crisis.
Exactly. And so that's a big pile of stuff to work through. And they've done that now. And it's kind of the next step is here. And Jane is the one to lead them out of it. But it's definitely, they're behind and they have to catch up. She knows that. She's pretty public about wanting to do that and crush the competition along the way.
What do analysts say is the right way to crush the competition, to get to a point where they're actually valued like one of their peers?
And by that, he means Mike Mayo. No, I'm just kidding.
We talked about Mike Mayo yesterday at Wells Fargo.
Yeah, everyone wants to see them do better. I think the big thing that a lot of folks really want to focus on actually is their payments business. It's a little bit of a sleepier business, but it actually handles payments for most of the world's largest companies. So, if you're a major company like a Coke or something like that, and you need to pay a supplier in Kenya or wherever, you lean on Citigroup. They're basically the only bank that can really help you do that.
Because of their international footprint.
That's exactly right, yeah. And so analysts want to just see them talk about that more and kind of give that size and scope a little bit better. Payments companies are super hot right now. They're getting all these fun valuations. Citigroup is sitting on this enormous payments business. Analysts just want to hear them talk about that more.
The international part, is it good that they're everywhere? I mean, because that's one of the things you get into in your story. Mm-hmm. They certainly put it out there that it is, right?
I mean, they're torn on it. Jane is in the midst of selling off about a dozen consumer operations in Asia and Europe. So they seem to be de-emphasizing that aspect, but they are very much emphasizing that they are staying in those countries from an institutional side. And I think, it is something that makes them unique, the fact that they have these operations and can do payments and can, sell to customers and be there for folks anywhere in the world. But it means that anytime something, goes wrong in some far-flung place, Citi likely is there and has a view on it. And I think that sometimes gives investors a little bit of jitters.
Dare I ask, About bank earnings. Dare I even go there, Jenny Serene?
Ask away.
All right, so
we know the card business. We talked with Allison Williams at BI. We know the card business is an important one, right?
Yes.
Yeah. And what do you keep an eye on for later this week, especially when it comes to Citi?
I mean, cards, we had JP Morgan this morning. They are also huge in cards, and they were seeing really big upticks in spending on cards, and it just didn't materialize into loan growth. So I think the big question folks have is, when does this turn into borrowing? Are people continuing to pay down their debts, and what does that mean for the way these businesses are structured and how these banks make money?
Is there something that, it sounds like you guys got to cover a lot of ground. Is there something that you would like more particulars on, or as you continue to cover Citibank and continue to report that you will be watching really closely and think these are going to be future stories that I expect to come?
I definitely think the wealth management bet is an interesting one. And I love that she's going about it in such a different way, because I think that'll be really fun to watch and kind of see who ends up being right. Morgan Stanley, they like this big asset manager. They've married it to their wealth management business. So their asset manager is churning out products, and this fleet of brokers will sell that for them. She's going on a very different path. And so I think that's, a fun storyline to keep on track of and see who's right, who ends up making more sense as we all go more digital, and also just the insane explosion in wealth that we're expected to see around the world. I think it's going to be interesting.
What's she like? And the reason I ask is I think about the recent meeting that Biden just had, President Biden, with the big bank CEOs, and they were talking about the debt ceiling, and she was the one who spoke first. And so I thought that was pretty impressive. But what is she like as a person in terms of the feel that you got from her and the time you spent with her?
Yeah, I think she's a really genuine, authentic person. I think Mike Mayo in his note this week, he used the word change agent, and I think a lot of folks get that vibe that she's there and is ready to put her own stamp, and she's very much willing to kind of go her own path to do that. And so I think people respond to that, and it's working on the recruiting side. We'll see how it goes on the retention side. But I definitely think she's the fresh air that everyone talks about.
What do other big bank, final question, big bank CEOs, what do you hear, like kind of back channels?
I think, I think everybody has their own flavor. Jamie Dimon is Jamie Dimon. He's very out there and very outspoken. And he's been in the seat for so long. And so he's kind of like Father Time on Wall Street. So she's new and she's different. She's definitely not, Jamie. So I think that's the big difference here, and what we were trying to capture with the piece this week, and just show like there's someone new. There's a new sheriff in charge at Citi, and they've got a lot going on.
Definitely a different feel.
Do we see Goldman Sachs and other banks adjust their hours and adjust their schedules for their bankers as a result?
I don't think so. They just seem so adamant.
All right, we got to run.
Yeah.
Sorry, forgive us. Great cover story. Jenny Serene, we love it, on Citibank and Jane Fraser. To the White House we go, and President Biden.
You're hearing a lot about something called supply chains and how hard it is to get a range of things, from a toaster to sneakers to bicycles to bedroom furniture. And that's why back in February, I signed a piece of legislation on supply chain, an executive order on supply chains, and we had to move on it. And with the holidays coming up, you might be wondering if gifts you plan to buy will arrive on time. Well, let me explain. Supply chains essentially mean how we make things and how the material and parts get delivered to a factory, so we can manufacture things and manufacture them here. How we move things, how a finished product moves from a factory to a store to your home. And today we have an important announcement that will get things you buy to the shelves faster. I'm joined by the Executive Director of the Ports of Los Angeles and Long Beach, Gene Soroka, and Mario Cordono. I apologize, Mario. And the President of the International Longshoremen's Union, Willie Adams. Los Angeles and Long Beach are home to two of the largest ports in America, and together these ports are among the largest in the world. And the best way to make that point is that 40% of shipping containers that we import into this country come through these two ports. And today we have some good news. They're going to help speed up the delivery of goods all across America. After weeks of negotiation and working with my team and with the major union retailers and freight movers, the Port of Los Angeles announced today that it's going to begin operating 24 hours a day, 7 days a week. This follows the Port of Long Beach's commitment to 24/7 that it announced just weeks ago. 24/7 system, what most of the leading countries in the world already operate on now, except us, until now. This is the first key step toward moving our entire freight, transportation, and logistical supply chain nationwide to a 24/7 system. And here's why it matters. Traditionally, our ports have only been open during the week, Monday through Friday, and they're generally closed down at nights and on weekends. By staying open 7 days a week, through the night and on the weekends, the Port of Los Angeles will open over 60 extra hours a week will be open. In total, that will almost double the number of hours that the port is open for business from earlier this year. That means an increase in the hours for workers to be moving cargo off ships onto trucks and rail cars to get to their destination. And more than that, the night hours are critical for increasing the movement of goods because highways are less crowded in the evening, at night. In fact, during off-peak hours in Los Angeles, cargo leaves the port at a 25% faster pace than during the day shift. So by increasing the number of late night hours of operation and opening up for less crowded hours when the goods can move faster, today's announcement has the potential to be a game changer. I say potential because all of these goods won't move by themselves. For the positive impact to be felt all across the country and by all of you at home, we need major retailers who order the goods and the freight movers who take the goods from the ships to factories and to stores to step up as well. These private sector companies are the ones that hire the trucks and rail cars and move the goods. On this score, we have some good news to report as well. Today, Walmart, our nation's largest retailer, is committing to go all in on moving its products 24/7 from the ports to their stores nationwide. Specifically, Walmart is committing as much as a 50% increase in the use of off-peak hours over the next several weeks. Additionally, FedEx and UPS, two of our nation's biggest freight movers, are committing today to significantly increase the amount of goods they're moving at night. FedEx and UPS are the shippers for some of our nation's largest stores, but they also ship for tens of thousands of small businesses all across America. Their commitment to go all in on 24/7 operations means that businesses of all sizes will get their goods on shelves faster and more reliably. According to one estimate, together, FedEx and UPS alone move up to 40% of packages in America, up to 40%. And other companies are stepping up as well. They include Target, Home Depot, and Samsung that have all committed to ramp up their activities to utilize off-peak hours at the ports. So, the commitments being made today are a sign of major progress in moving goods from manufacturers to a store or to your front door. I want to thank my supply chain disruption task force, which we set up in June, led by Secretaries Buttigieg, Raimondo, and Vilsack, and by my Director of National Economic Council, Brian Deese. I want to thank them for their leadership. And I especially want to thank Joe Procari. I think Joe's done one heck of a job, my special envoy specifically on ports, who's been working this issue with all the stakeholders for the past several weeks. I also want to thank the port directors. I want to thank Gene and Mario again, and the mayors of Los Angeles and Long Beach, Mayor Garcetti and Mayor Garcia, for their leadership. And I think the private companies that are stepping up, I want to thank them, but I particularly want to thank labor. Willie Adams of the Longshoremen and Warehouses Union, who is here today, the Teamsters, the rail unions from the Brotherhood of Railroad Signalmen, and the International Association of Machinists, to the American Train Dispatchers Association, to Sheet Metal, Air and Rail, and Transportation Workers Union, known as SMART. I want to be clear. This is across the board commitment to going to 24/7. This is a big first step in speeding up the movement of materials and goods through our supply chain. But now we need the rest of the private sector chain to step up as well. This is not called a supply chain for nothing. This means that terminal operators, railways, trucking companies, shippers, and other retailers as well. Strengthening our supply chain will continue to be my team's focus. If federal support is needed, I will direct all appropriate action. And if the private sector doesn't step up, we're going to call them out and ask them to act. Because our goal is not only to get through this immediate bottleneck, but to address the long-standing weaknesses in our transportation supply chain that this pandemic has exposed. I might add, parenthetically, one of the reasons why I think it's very important that we get the infrastructure plan passed, my infrastructure plan. And that supply chain system is almost entirely in the hands of private business. The world has changed. Prior to the crisis, we cheered, the focus on lean, efficient supply chains, leaving no buffer or margin for error when it comes to certain parts arriving just in time is needed to make a final product. And our administration, Barack and ours, that's where it was just in time was the focus. We didn't have a pandemic and other things at the time. We need to take a longer view, though, that invest in building greater resilience to withstand the kinds of shocks we've seen over and over, year in and year out, whether it's the pandemic, extreme weather, climate change, cyber attacks, or other disruptions. In fact, research tells us that a company can expect to lose over 40% of 1 year's earnings every 10 years due to supply chain disruptions. A longer-term view means we invest in systems that have more time built in and our ability to produce, innovate, and partner with our allies. It also means companies throughout the supply chain, like maritime, air freight, and trucking companies, reduce their carbon emissions and help to meet our climate change goals. It also means creating and supporting good-paying jobs so folks want to stay in these jobs, so they can build the skills and careers and to make a decent living. It means more opportunities to join a union, especially for truckers. These steps are critical. They allow companies to pivot quickly when a disruption hits because they've invested in their workers' skills, and training up front to be able to adapt. We need to invest in making more of our products right here in the United States. Never again should our country and our economy be unable to make critical products we need because we don't have access to materials to make that product. Never again should we have to rely too heavily on one company or one country or one person in the world, particularly when countries don't share our values when it comes to labor and environmental standards. I've said before, we're in the competition for the 21st century. We are America. We still have the most productive workers and the most innovative minds in the world. But the rest of the world is closing in, and we risk losing our edge if we don't step up. In order to be globally competitive, we need to improve our capacity to make things here in America while also moving finished products across the country and around the world. We need to think big and bold. That's why I'm pushing for a once-in-a-generation investment in our infrastructure and our people with my infrastructure bill and my Build Back Better Act. These bills would transform our ports. There's billions of dollars for ports, highways, rail systems that sorely need upgrading and would bring products faster and more efficiently from the factories to the store to your house. Let me be clear. We're proposing to make the biggest investment in ports in our history. The bill would also make investments in our supply chains and manufacturing and strengthening our ability to make more goods from the beginning to end right here in America. The bottom line, we've seen the cost of inaction in the pandemic, and the delays and the congestion that affect every American. But it's fully within our capacity to act to make sure it never happens again. It's going to take a little time, and that we've unlocked the full might and dynamism of our economy and our people. That's what we're going to do. God bless you all, and may God bless the longshoremen, rail workers, truckers, and all the workers who are keeping our economy going. May God protect our troops. Thank you all so very much.
So that is, of course, President Joe Biden speaking there at the White House. The Biden administration trying to relieve supply chain bottlenecks ahead of the U.S. Christmas shopping season. We talked about that with the head of the International Council of Shopping Centers. Officials acknowledging their options are limited as soaring consumer demand tests transportation and delivery networks. The president, though, saying we need to improve the capacity to make things in the United States.
Yeah, the president said that we also need to improve capacity to make things in the United States and called out several private companies, publicly traded companies, including Walmart, UPS, FedEx, Samsung, Home Depot, and Target, talking about how those companies are, in his words, stepping up to help with the challenges that the country is facing.
And on the other side, most people would say, listen, it's a global supply chain. There's no going back. But we know from conversations that we've had that people are diversifying their supply chain so that if there are bottlenecks, problems in one part of the world, they can look elsewhere.
It was interesting what Cameron Christ told us. This is an issue not just of supply, but also one of demand.
That's a good point.
We're seeing, with the supply chain issues, we're seeing supply challenged, but we're also seeing an increase in demand for products. So the companies are getting hit on both sides. And prices are moving as a result.
Exactly. And another, I think, important aspect to what the president had to say, he did say he will direct federal support for the supply chain when needed. So we'll have to see maybe potentially where that support lies when it comes to the U.S. supply chain. Hey, let's head to the host of Sound On, Joe Matthew. He is out there in D.C. Joe, you've been listening to the president. I think he spoke for about 4 or 5 minutes there. What stands out for you?
Yeah, I'm joining you from the White House, in fact, where we've been waiting for quite some time to hear from the president following this meeting. It's just, you've got to keep in mind, and I think you guys are kind of edging up to this, that this entire supply chain we're talking about is controlled by private enterprise, from the ships that are all lined up to the port, to the warehouses, the trucks, and the rails. So the White House is, once again, not unlike in dealing with the oil market, finding itself with not a lot of leverage here and actually asking for help. They describe, the press secretary, Jen Psaki, described the announcements today as huge, and they are feeling pretty good about what they've managed to put together here. 24/7 at the Port of Los Angeles, following a similar announcement from the Port of Long Beach. And helping to coordinate. Why didn't they do that
sooner? Tim was saying as he was, he's because why don't we do that right away?
Great question. I don't think many people realized, that this is a Monday through Friday operation. But the thing is, you can open up the ports, but you also, it doesn't matter. And you're just going to have things stacking up unless you get all the rest of this, right? It's FedEx and UPS, as mentioned. It's companies like Walmart that have their own trucking fleets, Target and Home Depot, Samsung in that meeting. So they can also work off-peak hours to help move the backlogs at the port. If you just let all the ships come in, you'd have, containers stacked up to the sky. This will have an impact. The president just made it sound like a substantial impact, but we're talking about roughly 3,500 containers moving at night for the rest of this year. And that's not a huge percentage, but it's an improvement. The White House sees this issue as critical to it getting through this economic recovery. I mean, you guys know a lot more about this than many of us here in Washington, D.C. When you're talking about economic growth, you have to have supply lines. It's not just getting the tax and spend plan on Capitol Hill. This is just as big a part of it.
Well, Joe, one thing that I was wondering about when the president was talking about these initiatives and when I was reading about these new initiatives that the White House released today is, okay, this is all well and good, but where are these companies going to find the workers who are going to do this 24/7?
And that is, you're absolutely right. What about the jobs? And that, just like we were asking, by the way, for the infrastructure plan, you're going to start thousands of construction projects tomorrow. Who's going to work there? So this becomes a story of wage pressure once again, likely. Now, we heard the president thank the Teamsters and the other related unions who are dealing with transportation, with shipping, with running the ports. They all pledged today to lean into this. But you have to get people to show up to work. You have to get people off the couch to apply for a job, start going to work, and be happy with what they're doing, or none of this works. So are we talking about signing bonuses? I mean, these are tough jobs, by the way. We're talking about driving all night in the middle of the night across the country if we're going to get stuff from ports to people.
So what does it mean when the president says we will direct federal support for the supply chain when needed? What does that mean? Money support? What is it? Policy? What is that?
Great question. Financial support, yeah. Arm twisting, too, maybe. You get a phone call from the president's team. Yeah. They need you to act. Hey, listen, we heard you guys didn't send enough trucks last night. What's going on? But it still comes back to Tim's question. You can put all of the hardware in place and the systems in place, but you have to have people to run them.
Hey, one name that I didn't see on the White House list today from a company was Amazon. And I couldn't help but think throughout the president's speech.
He was kind of busy today.
Well, he's not. I mean, the he you're referring
Just
to is Jeff
saying.
Bezos. But this is a company that is increasingly working on shipping its own goods across the country with its own fleet of 767s.
You're right.
And it's also got its own fleet of trucks out there.
End to
did
end.
that stick out to you?
It did. It's kind of like when they didn't invite Elon Musk to the EV event that happened here not that long ago, although that was apparently confused by a union issue. And maybe this was too a little bit. But you're right. Jeff Bezos is making a whole bunch of news today, but none of this appeared to be directed at him. And they've got not just trucks, but they've got the airplanes. They're asking for used airplanes now to fly stuff from Asia. So, yeah, maybe there was a missing share here, Tim. It's a good point.
Hey, Jeff, it's Joe on the phone. I just thought I'd talk to you. Anyway, good stuff. And I know this is going to be, I'm sure, on your plate come 5 p.m. Wall Street time. Sound On with Joe Matthew. He's the host.
Jeff says, hey, call Andy Jassy.
Not my problem. I'm flying into
going to
space.
space.
I'm working
I'm in
on
Texas.
I'm working on the Vulcan sign. Okay. You are listening to Bloomberg Business Week, though. Supply chain, it is certainly front and center, no doubt about it. And right now in D.C., our own Tom Keene, host of Bloomberg Surveillance on radio and TV, catching up with Jared Bernstein.
Good afternoon, everyone. Tom Keene in Washington. Important comments from the president, and we are thrilled you join us on Bloomberg Radio and Bloomberg Television for this first interview with the White House. And there is no one more qualified at the White House to speak of this president and his thoughts on labor and this supply shock that we have nationwide than Jared Bernstein. He's a member of the White House Council of Economic Advisors, but far more truly decades of work on labor economics and doing what's right for this nation. Dr. Bernstein, thank you so much for joining Bloomberg today. Jared, let me cut right to the chase. This was a speech for labor. Is labor to blame for this supply shock?
No, this supply shock has many parents. Most of them have to do with the pandemic itself. When the pandemic hit, we saw a real spike in demand for manufactured goods at a time when, of course, many people couldn't go to work. So we've had increased demand hitting contracting supply. This has been a story ever since before we got here, and that's why we've been talking about and organizing and working on this task force around these issues, culminating with some of the announcements you've heard today. But this is a problem that's been with us for a long time, and it's just like $21 trillion economies, international supply chains don't get shut on and off like a light switch.
Jared, Ken Rogoff of Harvard spoke to me about this over 15 years ago. And as a president, and frankly, folks, I thought it was the high point of the Biden comments, the president talked about just in time. We are now in a crisis. Just in time is dead. Is there a permanence here, or do we go back to the just in time of decades ago?
You know, listening to the president's comments, I think I hear more of a permanence, and I appreciate that you pulled that out. And the way the word I would use here is resilience. We simply have to build much more deeply resilient supply chains. That's certainly the goal that he set out for our supply chain task force, led by many of the secretaries that you've been talking to today. And one of the key ways to increase resiliency is to broaden the portfolio, increase the economy's supply side. One of the ways you do that is by moving to 24/7 at the ports. And in order to do that in the Port of LA, the president convened union, businesses, port leaders, all together to hold hands and make this change. It's precisely a microcosm of the kind of resiliency that we're trying to build in here for the long haul.
Jared, I want you to talk about Willie Adams and the Longshoremen. To most of our listeners and viewers, our complete knowledge of this is Marlon Brando on the waterfront, 1954. What's it really like? You are expert at this. Tell us what we don't understand about the union process that's part of this bottleneck.
Yeah, you know, I'm glad you brought up that old movie. That was formative in my own life. And I think one of the things that unions have done over the years is made sure that their workers get a fair share of the growing pie. Now, you know we've had this long-term inequality problem in this country. You and I have talked about it a lot. It's at the heart of President Biden's agenda, trying to create good jobs for union workers. And that's where Building Back Better comes in. It was interesting to me that he ended his comments today by talking about not just these near-term supply side, get things percolating again in time for the holiday season to meet that demand. That's obviously critical to us and to the American households. But over the long term, we have to build in that resiliency, and that means deep investments in ports, in climate, in workers, in education, training, and good union jobs to help serve those goals.
Jared, I want to talk about the pending legislation. I mean, all of this alludes to infrastructure, the failure of our airports. You went to Hunter College. The worst pothole in New York is on Lexington Avenue, just outside Hunter College.
I know that pothole.
You know that pothole. Jared, this is important. Link the infrastructure legislation and moderate Democrats, Stephanie Myers down in Florida, just as one example. Link the moderate Democrats' frustration with the president's need to help the progressives get this done in the legislation that helps us out of this supply shock.
Sure. Look, it's a great question. President Biden has always understood that when it comes to a big pothole on Lexington Avenue, that pothole is not a Democrat or a Republican pothole. It's just a pothole. And if you break your axle, which, by the way, I did in my GM Pacer back in the 1970s, so I know what we're talking about here. If you break your axle in one of those potholes, or you're trying to get home over a bridge that's not repaired, I don't know that you're thinking about partisan politics. I think you're thinking about, we need to invest in public goods once again in this country, something we just have not done for decades on end. And we see it in our R&D, we see it in our productivity, we see it just today in the difficulty in goods getting to markets. Now, obviously, there's a huge private sector component, and that's why you have the president talking to businesses, to ports, to unions. But there is a public infrastructure investment responsibility here as well, and no president has proposed such deep investments to get this economy back on track than we see in our infrastructure and Building Back Better agendas.
Away from the ports and the present need to steer this country forward, this is a president of a fractious Democratic Party. You're his core economic advisor. You've been longer with Biden than pretty much anyone else. Dr. Bernstein, what is your to-do list for the president in the coming days to solidify this plan and drive it forward to Christmas success?
It's another great question. Joe Biden doesn't come to me to say, what should my political strategy be? He's got those antennae better than anybody else in this dwelling over there. What he comes to me is, talk to me about how we can relink economic growth, productivity, and the prosperity of the American middle class. That kind of connective tissue, that policy is what he comes to his economic team for, to the members of the Council of Economic Advisors, the National Economic, the Domestic Policy Council. We're all working to try to craft the economic tissue to reconnect growing GDP and the well-being of the American middle class. And if you tick through the Building Back Better agenda, you will see that on every line. Good union jobs in improving the climate, healthcare, helping to be more affordable for families, prescription drug costs coming down, child care, elder care, educational accessibility, key issues for middle-class family. That's what he comes to his economic team for.
Let's talk about Build Back Better and trying to keep a Democratic majority in the House and the Senate. I know that's not your remit at the White House, but what is so important, Jared Bernstein, is the calendar. How long are you giving? What's your timeline on Long Beach and LA to improve and get this solved? Are we talking weeks to fix this? Months? Or is this going to go into the primary season of the 2022 election?
My understanding is that these changes are taking place as we speak. We've got Walmart, UPS, FedEx, Samsung, Home Depot, and Target talking about moving an additional 3,500 containers a week off of the ports into trucks with chassis and onto warehouses and then onto shelves. So this is fast-acting intervention. Longer term, that's where the Building Back Better agenda comes in. And look, again, I'm going back to this, the absence of investment in public goods, both in human capital, in education, in healthcare, in climate, and in concrete public capital, bridges, potholes, clean water systems. for the longer term, if we're going to address the supply side shortfalls that we're seeing here in a microcosm in a lasting way, then we have to pass lasting legislation to do so, and that's the infrastructure plan and Building Back Better.
Dr. Bernstein, thank you so much for joining us. This first conversation after the president's speeches. This has been wonderful for Bloomberg Radio and Bloomberg Television. Back to you, please.
All right, Tom Keene there in our D.C. bureau, as you heard him say there with White House Council of Economic Advisors member Jared Bernstein there from the White House. And it is all about global transportation supply chain bottlenecks. That is the conversation, certainly front and center, but interesting how it again turned to politics in terms of the infrastructure program and plan that President Biden and his team are trying to get through Congress.
Exactly. Yeah, Dr. Bernstein of the White House Council of Economic Advisors very quickly connecting the two issues and saying, hey, this is why we need to pass this plan, the Build Back Better plan as well.
Yeah, talking about investments needed for supply chain resiliency. All right, you are listening to Bloomberg Business Week. Carol Massar, Tim Stanovic. Let's get a check on the world of business. A look at the trading day. Here is Charlie Pellet.
Thank you very much, Carol Massar. 34 minutes to go ahead of that closing bell. We've got the Dow Jones Industrial Average down 19, right to the numbers here, drop of 0.1%. S&P up 8, up 0.2%, while NASDAQ higher by 85 points now, a gain there of 0.6%. Tech shares advancing amid lower Treasury yields after data showed inflation is running hot. Lifted companies seen as better equipped to pass on higher costs to consumers without harming their businesses. 10-year yield right now 1.54%, 10 years up 8.30 seconds. Spot gold up 1.8%, 17.92 the ounce, and West Texas Intermediate crude down 0.1%, 80.56 a barrel. Federal Reserve officials broadly agreed last month they should start producing emergency pandemic support for the economy in mid-November or mid-December, even as the Delta variant continues to create headwinds. Recapping stocks mix, but the S&P up 8 now, up by 0.2%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. This is Bloomberg.
Take it away, Wilson.
All right. I mean, you had to pick this one because, of course, William Shatner going into space on the Blue Origin ship, oldest man ever, oldest person ever to go up. And that song actually comes from an entire album of covers of songs with ties into space or science called Seeking Major Tom. It actually came out this week 10 years ago.
Wow.
So he was
timing.
80 when he did that. Now he's 90.
I cannot believe he's 90.
He's pretty impressive.
Oldest person now
Yeah.
to go to space and return.
Yeah.
Yes.
Cool stuff.
Absolutely. In any case, let's get to the chart, shall we?
Is it in space? Is it on Earth?
It's very much on Earth. It's all about, how people feel about things. I mean, William Shatner's probably feeling pretty good about his trip about now. But the question is, how do consumers feel? I mean, you have all these monthly surveys that try and get at. One of them comes from the Conference Board. And the folks at Morgan Stanley Wealth Management did a little comparison between that index and the S&P 500. And they looked at year-over-year percentage changes as a way to kind of see how sentiment and share prices are shifting, because a lot of times they move together. Lately, it has not panned out that way. And it's a concern for the money management side of Morgan Stanley, because if they don't see much improvement anytime soon, they're concerned about what consumers are going to do down the line, whether it's, as they put it, a signal of market weakness, whether people decide to save more and spend less, because we know very well consumers are a big chunk of the U.S. economy. In any case, if you want to see this chart, folks, send me an email. I'll get it to you with the explanation that goes with it and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
What?
I'm thinking of Danny Blanchflower.
I was just going to say, I think he's been front and center with this.
I got news for you.
What?
I heard from Danny Blanchflower after I put this chart out to my email list.
I bet he said, Dave Wilson, check the Bloomberg because I wrote something about it, or Simon Kennedy wrote about me, and Tim and Carol had.
Well, he didn't go into that length, but he basically said that's what my latest paper is about. So
it is.
There you go.
It's very interesting, right? And he said basically we're already in a recession based on consumer sentiment indicators, and as a predecessor to seeing a downturn.
Yeah, absolutely. I mean, that's the concern is, where do we go from here, especially with, so many companies facing higher costs down the line? Can they keep passing them on to consumers? At some point, do they balk? These are the kinds of issues that as we get through third quarter results are going to be front and center.
All right. Dave Wilson, just very briefly, give us your stock of the day.
Paycor HCM. We're talking human capital management, which is another way of saying employee management software. The ticker is PYCR. The company went public just, 3 months ago. And now Apex Partners, the majority owner, private equity firm, and a couple other firms are selling more shares. 12 million of them to be precise. So the stock down more than 7% as that sale plays out.
Look for Dave's stock of the day just after 4:15 p.m. Wall Street time. You can find it on Facebook, LinkedIn, and on Twitter @TheOneDave. Dave Wilson, stocks editor at Bloomberg News. Thanks, Dave.
All right, Dave Wilson, thank you so much. You're listening to Bloomberg Business Week. Carol Masser along with Tim Stanovic. So some COVID headlines, right, that we have certainly focused on today. The World Health Organization proposing a fresh team of scientists to lead an investigation into the origins of COVID-19 and other diseases after the last effort was racked by controversy.
Also, New York's vaccine mandate appeal has been delayed as hospitals look to seek clarity. Let's get into it with Dr. Bruce Farber, Chief of Infectious Diseases at Northwell Health's North Shore University Hospital and Long Island Jewish Medical Center. Dr. Farber, it's great to chat with you again. We always like to check in with people who are in your position, first just to get an update on how things are looking in the hospitals, especially compared to at other points during the pandemic. So give us an update from Northwell Health.
Well, things are operating smoothly. I will say that our numbers significantly declined initially, but they've leveled off over the last several days and are actually slightly higher than they were a week or two ago. So we're much lower than we were obviously 6 weeks ago, but we're not out of the woods. And I think some of us were surprised that the numbers have been persistently as high as they have, hoping that they will continue to slowly edge down, but they've kind of stabilized, quite frankly.
Again, the question that I have for you are the people who are hospitalized, portion vaccinated versus unvaccinated.
Well, the overwhelming majority are unvaccinated, but in all fairness, it's between 10 and 15, sometimes slightly higher, are vaccinated, and certainly we're seeing breakthrough cases. The breakthrough cases of people in the hospital who are vaccinated are not nearly as sick. Very few of them are in the ICU, and certainly very few, if any, are on ventilators. At the moment, I don't believe there are any. And they're usually elderly and they're usually immunosuppressed. So the vaccines are still doing a good job in preventing the vast majority of hospitalizations, but it's not 100% by any means.
Hey, you guys, Dr. Farber, have a massive hospital and healthcare system in New York State, and you guys have seen a lot over the last year and a half, and hard to believe we're almost coming up on 2 years when it comes to this pandemic. We're not quite done yet. Having said that, you've got a plan for what might be coming in the next few months, and as it gets colder, more people inside, certainly here on the East Coast and elsewhere in the United States. Are you planning for another surge when it comes to COVID?
Yes. I mean, we are definitely planning for a surge. We plan for the worst and hope for the best, as the saying goes. But yeah, we're planning for the surge and obviously for the possibility of a very bad flu season and respiratory season, which we totally escaped last year during the pandemic. Mm-hmm. People's masks are off, and immunity to flu is probably not as good as it was several years ago, because we lost a year. We don't know the efficacy of the flu vaccine that we're already committed to. And so, although, again, we hope that that scenario doesn't develop of two epidemics occurring simultaneously, we would be foolish not to plan for that possibility.
How do you plan for that?
Well, we have contingency plans for scaling up admissions, for cohorting people. We, needless to say, are hopeful that people will continue to get boosters who are eligible. Uptake on the boosters is okay, but not as good as I would like to see it at the present time. We have plans for, load balancing like we did during the other epidemic, meaning moving patients around to make sure that we don't have to close down other parts of the facility. We have the ability to continue our services as long as the capacity does not go above roughly 15% of our peak in March of 2020. We don't think we'll come anything near that, but, needless to say, you're always looking for the black swans that surprise you.
Well, right, exactly. If we've learned anything, whether it's the financial crisis, whether it's the pandemic, certainly from a health perspective, those black swans, they're out there and they can certainly turn our world upside down and continue to do so. Having said that, I've talked with various individuals who've gone to some health systems around the country. And again, anecdotes, just a sampling and a few cases, but going for some routine things or certain procedures above and beyond COVID. And it does seem like for those hospitals that are dealing with surges in COVID, it's pretty tricky that they're very quick to get patients out. And sometimes that can lead to complications. How do you manage, the surges in COVID and then also making sure that those are in there for different types of treatment or getting the care that they need without putting them at risk?
Well, 2 quick points. Some people, I think, are better off getting out earlier, less likely to get complications. And the two areas where we've pushed that are in labor and delivery, although some women may not appreciate having to leave so early. It's probably better for them. And we have moved those people along with their approval pretty quickly. And similarly, for certain events like joint replacement, we've been able to move those people out much quicker than we used to with very good results. In other situations, you're right, it's more complicated, but the last thing we want to do is to go back to the horrible problems that we had in the beginning of the epidemic, where many people died of COVID even though they didn't have COVID, meaning they delayed urgent care that was needed, whether it was for cancer or heart disease, and where we saw, deaths of spontaneous deaths from myocardial infarctions rising at home, and people were afraid to come to the hospital. So we will go out of our way to keep other services open and readily available.
How long does this continue, Dr. Farber? It's a question that we have over and over again, but it feels like, we're just learning how to live with COVID, and it sounds like you're learning how to be chief of infectious diseases in a world of COVID without it going away.
Yeah, well, my personal view is we're naive if we think that, we're going to hit herd immunity and this is going to go away anytime in the near future. And I don't know whether that'll ever happen. If you wanted to get measles today, you would have a very difficult time. Same with rubella, because there you really do have herd immunity. There's just, even if you're not immune, there's not any measles around for you to get, with these occasional spikes that we rarely see. That's just not the case with COVID. There are too many unvaccinated people. There are too many people having breakthrough infections. The vaccines aren't lasting long enough. The population is not fully immune. And so I think we have to learn to live with it and not think of it as that this is going to disappear anytime in the near future. And I'm not sure it'll ever disappear.
Well, on those notes, it's also why I keep ordering new masks and more masks into the household. Dr. Bruce Farber, thank you. I know you've got a lot on your plate, so thank you for finding time for us again. He is Chief of Infectious Diseases at Northwell Health's North Shore University Hospital and Long Island Jewish Medical Center, massive system, healthcare system here in the state of New York, on the phone from Manhasset, New York.
Well, let's head down to Washington, D.C. for a check on the latest world and national news. Nancy Lyons is standing by in the 99.1 newsroom there. Hey, Nance.
Hey, Tim. President Biden says the nation's supply chain bottleneck should be helped with the decision to keep the Port of Los Angeles open 24 hours a day, 7 days a week.
This is the first key step toward moving our entire freight, transportation, and logistical supply chain nationwide to a 24/7 system.
Biden says having ports open 24 hours a day, 7 days a week, will amount to 60 extra hours to load product onto trucks that can move faster during the late night hours. He's hoping it will have a positive impact on the distribution backlog. President Biden opposes the death penalty, and his Justice Department imposed a moratorium on carrying it out. Yet today, a government attorney went before the Supreme Court to ask the justices to reinstate the death sentence of Boston Marathon bomber Johar Tsarnaev, which a federal appeals court overturned. Bloomberg's Irv Chapman has more from Washington.
Justice Department lawyer Eric Feigen argued,
the experienced district judge impaneled an impartial jury against a motivated terrorist in furtherance of jihad.
The appeals court ruled the trial judge did not adequately probe the jurors' exposure to media coverage and ruled out evidence of a previous crime by the dead older brother, Justice Elena Kagan.
This court kept out evidence that Tamerlan led a crime that resulted in 3 murders?
Several justices suggested their view that the trial judge acted properly and therefore the jury properly sentenced Tsarnaev to death. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. You're hot and heavy on this story.
Love this story. Anything about planes, trains, or automobiles gets me excited.
You're such a boy.
Yeah, it's a good movie too, by the way. John Candy. Amazon looking to get some long-range cargo jets, used ones that are able to fly from China. This art by our own Matt Day and Julie Johnson. The company is shopping for some used long-range Boeing or Airbus cargo planes. This is according to people who are familiar with the matter. This is the latest evidence, Carol, of the e-commerce giant's ambitions to move products across borders itself.
So we go shopping for socks and stuff, and Amazon goes shopping for jets, long-range jets. Amazon apparently in the market for refurbished cargo versions of one of the largest twin-engine passenger jets currently flying, so Boeing's 777-300ER, along with conversions of Airbus's popular A330-300 wide-body aircraft, according to those who requested anonymity to talk about confidential matters. Both models a step up from the mid-sized Boeing 767 aircraft that have served as the backbone of Amazon's fleet for 5 years. You know what I take away from this? Amazon's fleet.
Yeah, it's massive. If you've been to airports, particularly Cincinnati, Northern Kentucky, CVG, the airport that serves Cincinnati, it's in Northern Kentucky. In the last few years, you might have seen Amazon Air. It was founded back in 2016. The idea was to speed shipments of products from the company's warehouses to shoppers. There's a big hub for Amazon Air at that airport. Amazon Air now has about 75 planes. It's got converted Boeing 767s and then some 737 narrow-body aircraft. It's got 4 turboprops on the way, this according to planespotters.net. So if it adds to these, this is mainly not for cross transatlantic or transpacific flights, right?
Long flights.
Yeah.
Long flights.
Right. This is for stuff in the U.S.
Oh, is it? Oh.
Well, this would be, the
Right.
difference would be.
They're stepping it out.
Exactly.
And this is what it would let Amazon do, is directly import products from China and other countries, according to those people in the know. So it really would step up Amazon's rivalry with the likes of UPS and FedEx. I mean, that's what this is about. And I just think about some of the conversations we just heard from Jared Bernstein in terms of supply chains and the president, of course, on this. But the other thing is they're going to be looking for crews. So you're just going to talk about demand for pilots going up. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell. Choppy session. The Dow swinging between gains and losses. Down 3 right now, down less than 1/10%. Virtually flat on the day. The S&P up 11 now, up 0.3%. NASDAQ up 97, higher by 0.7%. Traders are assessing minutes of the Fed's latest policy meeting. Federal Reserve officials broadly agreed last month they should start reducing emergency pandemic support for the economy in mid-November or mid-December, even as the Delta variant continued to create headwinds. Again, the S&P up 12, up by 0.3. 10-year yield 1.54%, 10-year up 10/30 seconds. Spot gold up 1.8%, $17.92 the ounce. And West Texas Intermediate crude down 0.1%, $80.54 a barrel. Recapping, stocks are higher. S&P up 12, a gain of 0.3. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
23 species have disappeared forever, the U.S. Fish and Wildlife Service recently said. The world can expect many more such grim announcements if humans don't take action. Up to 1 million species are at risk of extinction, according to the latest global biodiversity assessment. Human activity is largely to blame. Our species can do better, and has every reason to. The OECD has calculated that the services biodiversity provides to the world, such as pollinating crops, purifying water, and storing carbon, are worth up to $140 trillion a year. New conservation efforts should be paired with action to fight climate change, a key driver of species loss. The people of this planet can leave their children a world rich in biodiversity, or one that's poor in every way. It isn't too late to make the right choice. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, so we've got about 10 minutes left in the Wednesday trading session. Lucky for us, back with us is JJ Kinahan, Chief Market Strategist over at TD Ameritrade, joining us on the phone from Chicago. We do this as we see stocks definitely off their lows of the session, and really the momentum coming out of the tech sector as we've seen certainly yields come down, particularly that 10-year bond coming down. Hey, JJ, nice to have you back with Tim and myself. What are you guys talking about at TD Ameritrade today?
I think everybody was very interested in the start of earnings season, primarily, and I would say that although the stocks maybe haven't responded, we were off to a good start overall in terms of what the financials kind of laid out for us this morning. And, Delta maybe...
It's a good start. JP Morgan's down a little bit.
I know. As I said, the stocks are down, but I think that the overall tone of the earnings was still pretty good. There's no question about that. JP Morgan, BlackRock down a little bit, no doubt about it. But, I think there were some worries going in that what if the financials have issues also? Because I think most of us are expecting that as the earnings season goes on, particularly as we get toward the tail end and we start to get more retailers, it's going to be very difficult because of, you talk about supply chain issues on the show a lot. And that's something that's going to come into bear. And I think it's going to be very difficult for some of those CEOs to put a real positive picture around that, particularly as we head to the holiday season. So I think the fact that the financials came in, yes, the stocks are down. We know there were a lot of expectations around the financials. I think we're going to continue to see that pattern over the next few days. A lot of expectations, tough to meet those expectations. But the tone of the earnings calls,
pretty positive overall, and the growth continues, but at a slower pace.
Okay, even Delta Airlines? I mean, shares down more than 5.7%.
Yeah, the airlines, I'm sorry, the financials I thought were good. The airlines, this one's a little bit tougher overall, right? And I think we may see a similar pattern for some of the transportation companies. Let's face it, their biggest input in most cases is gasoline. Yeah. And we know what happened with gasoline. And we also have, the Southwest story seems to be a little bit more stock specific rather than an overall airline story. However, maybe a little bit of a slowness of people taking up domestic travel. And I think the other thing that's really may hurt the airlines is, anecdotally, I travel a lot for business. I just think business travel is continuing to be taking a little bit longer to get back on track than the airlines expected. And now you're at this time of year where a lot of family holiday travel is over because the kids are back in school. Business travel hasn't picked up necessarily to the level that I think many of the airlines would have expected. So it's a tough time for them.
Yeah, I'm wondering, Carol and I are actually jumping on a plane tomorrow for the first time. Well, I traveled for work once over the summer, but Carol, you haven't traveled for work in, 18 months?
February 2020, Super Bowl, we were doing some stuff down in Miami, a big broadcast and a Bloomberg Live event. That's it. I have not been on a plane.
That's almost 2 years.
I mean, I had to, you and I were talking about TSA. I had to re-up my thing because it expired.
I'm not waiting for you at security.
I know you're not. JJ,
just kidding, I will wait.
We'll see. The supply chain problems, inflation problems, transitory. If these things are a bigger dislocation, that's just not a temporary thing, that this becomes part of the new norm, what does that mean for our environment? Is it a case of an uncomfortable adjustment for a few more quarters, and then it just becomes part of the way things happen? Or, I don't know. Or... Yeah, how do you see it?
Well, so inflation, is, in my experience, is something that kind of just goes slowly, and then all of a sudden. And so, you see the reaction in the bond market today in terms of maybe not as frightened, I guess, about it. Because bonds being higher, yields being a little bit lower, that would tell me that people aren't as frightened about it. But again, this is one day where we are having this big move. I certainly don't think you can say inflation is over by any stretch of the imagination, but it's just such a strange time. The supply chain, LA ports going 24/7. Hopefully that helps. I really don't think we start to see the true effects of that until for another in about a month to a month and a half. I think we'll have a real clear picture. Why? Because at that point, holiday shopping season should be in full level, so to speak. And if there isn't things that people can get delivered quickly, or probably more importantly for many of these stores right now, this is why you have a brick and mortar store, is usually the holiday season. And if there's not the things on the shelves that people want, that unfortunately could be another death knell for many of the brick and mortar stores.
Hey, speaking of the holiday shopping season, Apple shares taking a hit today. Not that big, just down close to 0.5 percentage point right now. This on our colleagues' report that it'll likely slash its projected iPhone 13 production targets by as much as 10 million units. We hit that hard yesterday. How did you read into that news and Apple's ability and other companies' ability to successfully navigate the supply chain issues in the fourth quarter?
Well, Apple obviously is superior at it. But one thing I will say, Tim, in terms of just how our clients trade that stock, Apple and Microsoft are in a little bit of a category unto themselves. And the reason I say that is they get a unique benefit. Many people, seeing them as blue chip, mature companies, which they are. So when we head to the downside, a lot of retail traders will go to those two stocks for, air quotes, safety. However, when things get better and we start to see tech stock starts to go up, they also go to them for growth stocks. So, it doesn't surprise me, actually, that the bad news there isn't met with some, a bigger reaction than it is, because again, this is one, when we talk about the buy the dip, as has worked for many people over the last, 8-10 years, pick your time frame. This is one of the stocks that usually from a retail perspective is one of the first leaders in terms of buy the dip. So people are looking for opportunities. If Apple, this isn't one where Apple goes down, people say, oh my God, I got to get rid of it. This is when Apple goes down, people say, I got to get more.
All right, got to run. Hey, be well. JJ Kinahan, Chief Market Strategist at TD Ameritrade, on the phone from Chicago. Just a few minutes left in the trading session. We're just off our highs of the session, so that means up about 12 points on the S&P, Dow up about 3. The NASDAQ really the outperformer on a percentage basis and point basis for that matter, up 0.7%, up 97 points as we speak. All right, coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and on YouTube, counting you down to the close on this Wednesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, the persistent Taylor Riggs, counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast. Carol Massler, Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences here on a day where we learned that women's dresses are now 9.5% higher than they were a year ago.
So that's how I tell my husband when the bills come in, why it's so much more.
But on the month, they're lower.
On
the month, they are lower.
Men's pants up 7%.
Yeah, all right. But
hey, they're all stuck in ships.
Women, we all get stuck. We get stuck with the worst stuff. Hey, listen, what an interesting day. It's a Fed Wednesday. We got minutes. It's, I feel like, a supply chain Wednesday. We heard the president speaking about it, Jared Bernstein talking about it. I'm watching financials. They are the worst performing major industry group in the S&P 500. Second best performing for the year, but not having such a great day today.
Yeah, it's so interesting, Romaine, bringing up the inflation numbers, the reading coming in hotter than expected, but investors really, the market kind of shrugging it off. But a good reminder, Caroline, that inflation isn't going anywhere transitory. What does it mean?
I mean, and also, are you camp Jamie Dimon, or are you camp Larry Fink, or indeed the Goldman Sachs president, both who seem to be more worried about inflation, saying it's not transitory, saying it's their biggest concern, and it's what they're hearing from CEOs. Meanwhile, Jamie Dimon says, look, this isn't actually stymieing growth yet. This isn't going to set it in reverse.
Well, you mentioned the Goldman Sachs president, John Waldron. I mean, he talked about really the idea of how are we defining transitory. So I think when we kind of joke, Taylor and I having this debate, it's really moved beyond whether it's transitory or permanent. It says, what are we defining as transitory?
Well, and is it, sorry, Carol, the rate of change of prices just not moving up at the same rate, or are they just moving up at a slower rate, or not moving at all, but certainly not moving back down?
Yeah, and it's been really some tepid days here. Basically, 4 straight days here for the S&P 500 that have been relatively meager here. We're coming off 3 straight days of losses. It looks like today we're going to finish in the green, but only by about 0.3%. The S&P 500 up 13 points right now. The NASDAQ Composite having a much better day here, up about 0.7%. That's largely because of some of the tech stocks like Microsoft, Amazon, higher on the day. Apple sitting this one out. Dow Jones Industrial Average looks like it's going to finish the day, Taylor's favorite, right around 34,378. And you take a look at the Russell 2000, those small cap cyclicals. Again, this isn't really much of a rally. It's up 0.3% here. I guess it's in the green. That's good enough for some people, but it shows you that, Carol, maybe people are waiting for something, a little bit more clarity about what holds for the future.
Absolutely. It feels kind of, a limp towards gains today, right? And I agree with you that we're looking for something much more definitive. Maybe we'll get it from more of the big banks later this week, and certainly as we get deeper into earnings. And forgive me, Taylor, for stepping on you, but I do think about transitory. We were talking about Cameron Krise earlier, and he said, I said, when is transitory not transitory anymore? And he's like, we're already there. I mean, this is part of kind of the new dynamic.
I'm forgiving you, Carol, because you're on Team Taylor. We just got to convince Romaine to get on Team Taylor and Team Carol.
Romaine.
Let's take a look at what I called earlier some of the broad-based gains, and Romaine was nice enough to correct me as we take a look at the sectors of the S&P 500 for our radio audience, as we usually do for the winners and the losers. And there's a little bit of green, but it pretty much is 50-50 when it comes to what's in the green and what's in the red. We'll start with what is in the green. It's a lot of the consumer durables, the utilities, software and services. These, of course, are some of those bond proxies as yields have really come down on the long end. You're up 1 to 1.25%. Carol, finally, we'll just end at the bottom of the screen. It's a lot of food and staples, some of these consumer services, and dare I say it, banks. We've talked a lot about JP Morgan and then what is to come. Bank index pulling back a little bit on the day, down 1.3%.
Is he really not on Team Taylor? Because Tim and I are going to come find him later.
Oh, thank you.
You're very welcome. All right, let's talk about chips. We were all over it yesterday when Apple came out and said, you know, we're going to have to slash iPhone production because of a chip crunch. And you got kind of a mixed trade here. But TI, I think, was down a little bit. The SOX was up. Xilinx was one of your top performers today, up about 3.7% in the trade. And you might remember back in August, it was very, very popular among the hedge funds. We saw that when we got those 13F filings. So they were really all in on it. CrowdStrike, I want to mention that one as well. That stock was up about 7% in today's session. A lot of analysts coming out and saying that they're positive on the cybersecurity software company. This is after it hosted a product event that was seen as underlining the company's growth potential, top of the NASDAQ 100 and up about 27% so far this year. Vimeo, thank you, Tim, for that one. That's a gainer. Rallying up about 13.6%. Reported monthly metrics for the month of September that analysts say show faster than expected revenue growth. However, firms note that the video software company is facing difficult year-over-year comparisons ahead. So we'll keep that one on our radar, Tim.
All right, well, let's talk Delta because the company closed down 5.8%. Company stock down, biggest drop in a year. The company reported earnings this morning. They beat analyst expectations, also reported the first government aid-free quarterly profit among big U.S. carriers since the start of the pandemic. But jet fuel costs absolutely weighing on the company. They've risen as high as an average of $2.40 a gallon. That's what the company's CEO, Ed Bastian, told Bloomberg News he's expecting for the current quarter. That's up from $1.94 a gallon in the third quarter. Bastian saying that fuel prices have risen 60% so far this year. Shares of JP Morgan down after reporting earnings that pretty much beat expectations almost across the board. Record quarter for M&A. Adjusted revenue for the third quarter beat estimates. Shares, though, lower today as consumers and commercial loan growth remained challenged. JP Morgan shares finishing it down more than 2.5%. Also, Romaine said that Apple is sitting this one out. Certainly is finishing off of its lows, but still down more than 0.4%. Shares taking a hit on our colleagues reporting late yesterday that it will likely slash its projected iPhone 13 production by as much as 10%. A lot of analysts weighing in today, though, guys, saying that this could hurt revenue for the quarter, though it's likely temporary. In other words, transitory.
Well, of course, that inflation data, the transitory note that we heard of CPI, not so transitory, and that had a big impact on the likes of the dollar, on the likes of yields today, but we see the dollar index sitting it out too, off by 0.5%. Significant move when it comes to the dollar index, and we see therefore, basically on the FX part of my screen, if you're looking at the vertical there, and for our radio audience, I'm looking at a Swedish krona up more than a percentage point, the euro doing well, up 0.5%, Danish krona as well on the higher side, but a lot of the FX moves, the Aussie dollar and the likes, the Canadian dollar, all related to commodities as well. Oil actually pulled back a little bit today as we saw OPEC perhaps questioning some of the growth that they thought in terms of demand. But natural gas back on a tear. If you see up 2.8% here in the US, but it was up 8-9% over in Europe. We're worried once again about the energy crisis. That spills into the like of zinc on the upside as we start to see a pullback in the commodity being made because of the energy crisis. We're seeing overall steel down about 0.5% and sovereign bonds across the board. Yields high. Look at this, 30-year in the UK, so gilts up more than 10 basis points. We're seeing money move into the Swiss 30-year as well. There was a movement in to the long end, at least to a certain extent, Taylor.
Yeah, that certainly is what you saw here within the U.S. as we talked about the strong auction yesterday. The 30-year auction today also pretty strong when you take a look at the average bid to cover and some of the non-dealer bidding activity that we saw. You're down 5 basis points on the day on the long end to a 204, 3 basis points lower in yield on the 10-year to a 154. You're still at the higher end of where we've been lately in the last few months.
Do you remember when yields, when the 10-year went above 1.6 and then everyone said, oh, here we go, we're headed towards 2.
Oh,
what happened,
Romaine,
Taylor?
the jokes. Maybe it'll get
Team
there.
Taylor, Team Taylor, come on.
They're no joke. I never joke here.
Carol, you know what's interesting, though, is we fold in the yield conversation with the CPI data that we got this morning. My favorite research note headline said, if you X out most everything in the report, inflation is low.
How do you do that? How do we all X out what we're paying?
I have a trivia question for you. Do you know there quite a few things actually dropped year over year and month over month? You know what the biggest drop was? Can you guess?
Airfare? No.
Oh, nice
Sewing
idea.
machines.
Oh, necessary.
Wasn't going to get
because there's no cotton.
Telephone hardware and calculators down 14%. Audio equipment was down 9%.
You're not doing the math.
This is news you can use.
I don't know
To
what
all
to
of our
say.
viewers and listeners, you're welcome.
Yeah, sewing machines. Okay, so we do know inflation came in higher than forecast. Growth of inflation also picking up here. I guess it all ties together. I feel like one of the big stories today was all about supply chains, everybody. Jamie Dimon talked about it. Everybody's talking about it. Tim, we were talking about it with a lot of guests.
Yeah, the
Just
president's
have to work
certainly
overtime, and we'll get all this done 24/7. That's right.
No sleep for anyone.
Here's my question about that. One, how has this not been happening up till now, right? How has there been capacity that has been sort of left unused? But the other part is, where are they going to find the workers to work 24/7 here?
Right.
I mean,
I know.
That's the hard part.
And I think it was really interesting in the president's speech earlier how he said he was going to call out the private sector, Caroline, if they didn't step up. And from most of the earnings reports we've mentioned, they've talked about supply chain 3,000 times.
Yeah.
I mean, they're not trying to hold this back by any means.
Is it all overblown? JP Morgan, Jamie Dimon, said it is. He says it's the media's problem. We keep on talking about supply chain issues. We keep on talking about inflation. He's saying that's not holding back growth. In fact, we can just take a listen to him. Have a moment.
Let's listen to him.
Hopefully a year from now, there'll be no supply chain problem. The pandemic will become endemic. And I think it's very good to have good, healthy growth, which we have. And I think it's going to be good to have unemployment at 4%. It's good that there are jobs that are open. I think it's good the wage is going up along again. I think there's too much focus on, and none of this changes how we run the business.
Jamie Dimon there of JP Morgan. He's not worried, but wage growth, he talks of it. Maybe you're going to have some wage growth, particularly in, well, the supply chain issues over in LA ports, at least.
Yeah, exactly. Why does the media always get blamed for everything? We're just
It's always
reporting the
our fault.
facts.
If we just stop pointing out the problems, there would be no problems.
Well said, Romaine.
You know, Confucius, our own Confucius. All right, we're going
We're
to
going to be out at the ports next week, by the way.
Yeah.
We are going to be out on the West Coast. All right, folks, we've got to run. That's going to do it for Beyond the Bell, our cross-platform coverage on radio, on TV, on YouTube. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It is an interesting point, and it is funny to hear like the media being blamed. I don't know, and I do wonder, are companies holding back to some extent, not wanting to? I don't know. I'm not quite sure.
We heard
how
FedEx
this plays out.
FedEx, the way that FedEx talked a few weeks ago about actually reducing capacity a little bit so service wouldn't get degraded.
Yeah.
All right.
All right.
Let's head to Washington, D.C. for a check of the latest world and national news. Nancy Lyons is standing by. Hey there, Nance.
Hey, Tim. The Biden administration is trying to relieve supply chain bottlenecks ahead of the U.S. Christmas shopping season, but the increased demand is testing transportation and delivery networks. President Biden met today at the White House with executives of delivery companies, port officials, and labor leaders, hoping to come up with some solutions. One of them is to open the Port of Los Angeles 24 hours a day, 7 days a week.
That means an increase in the hours for workers to be moving cargo off ships onto trucks and rail cars to get to their destination. And more than that, the night hours are critical for increasing the movement of goods because highways are less crowded in the evening, at night.
Biden is also asking retailers and trucking companies to step up. And if they don't, he says they will be called out. Since the supply chain is largely a private sector system, Biden's options are limited. Among the companies committing to extra hours for transporting goods, Walmart, Home Depot, and Target. Actor William Shatner has become the oldest person to fly in space after being part of the crew of Blue Origin's latest launch today. The 90-year-old Shatner spoke on Blue Origin's live stream with founder Jeff Bezos following the flight.
What you have given me is the most profound experience I can imagine. I'm so filled with emotion about what just happened. It's extraordinary.
Shatner was joined with 3 other civilians on the trip. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. So, Katie Greifeld, we just love you.
Yeah, she's my co-host of Quick Take Stock. It airs each day at Bloomberg.com/QT and streaming platforms like Roku, Apple TV, Samsung TV, and more. Noon Wall Street Times.
Hashtag shameless plug.
Yep, there it is.
It's all good stuff. Katie, though, who often writes about crypto and the markets and all this great stuff, she's writing, well, it has a financial angle to it. She says even Harry and Meghan, yes, that Harry and Meghan, are joining the Build Your Own index craze.
The freshly minted impact partners, that's in quotes, and the more than a $1 billion asset manager Ethic, are the latest members of the bespoke indexing firm movement that's reshaping the U.S. investment industry. The fintech firm, remember, Prince Harry and Meghan Markle, they are investors, builds custom indices to ride the boom in environmental, social, and governance investing. Jay Littman, the co-founder and president, he's joined us to talk about Ethic on our show. We got to get him back on, Carol.
Yeah, we absolutely do. And I was just thinking about indexing in particular. We're going to talk about index funds a little bit later on our broadcast. It's the subject of a new book all about index funds in particular. I mean, everybody's jumping on the bandwagon. That's how it is. I feel like there is an index for everything.
Harry and Meghan making a splash too, right?
Why? What do you mean?
Spotify. I mean, they're doing Spotify too, right?
Well, they're investors, right?
Yeah.
They're doing. Oh, you mean their brand and their
brand,
empire?
Yeah.
Yeah, they're definitely branching out, and we knew that. You know, we have certainly seen them get into a lot of different things. I think it's interesting too that it's the ESG space, right? That is a tricky one, and I think a lot of folks would easily argue that we need a little bit more transparency and clarity because ESG can mean a lot of different things. There are certain parts of ESG that you can measure more easily than other parts.
This is something I want to talk to Robin Wigglesworth about, who wrote Trillions, the new book about a band of Wall Street renegades who invented the index fund, because I'm sure he has some comments on this. But the question is, when do we start to see, well, I was going to say, when do we start to see pushback on ESG? We already are.
Oh, absolutely.
Like, does it grow, though?
Well,
and does it change? Like, are there going to be regulations around what it is?
Well, I think metrics would help it so people could really compare different ESG investments and what it really all means. Anyway, fun story. Katie Greifeld, love you. This is Bloomberg.
Broadcasting live from the Bloomberg Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Turned out to be a mixed Fed Wednesday. Traders were assessing minutes of the Fed's latest policy meeting. S&P up 13 today, a gain of about 0.3%. The Dow down 0.5 point. NASDAQ rallied 105, up by 0.7%. 10-year yield 1.53%. 10-year up 11/32. Spot gold up 1.8%. 17.92 the ounce, and Bitcoin up 3.3% today. 57,219 on Bitcoin. West Texas Intermediate crude, little change, lower, down 0.1%, 80.55 a barrel. American Express and other credit card issuers tumbled as J.P. Morgan Chase attributed weakness in its card business to rising costs on marketing and promotions, sparking concern over heightened competition. J.P. Morgan Chase down 2.6%, American Express down 3.5%, Capital One Financial down 3.3%, and Synchrony Financial down by 2.6%. Recapping an advance for the S&P up 13, up 0.3. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks, Charlie. Well, Bloomberg reporting just yesterday that Coinbase Global starting a marketplace for non-fungible tokens, NFTs, looking to expand its revenue base by riding one of the hottest market trends of the past year. Our next guest, Tim, has some thoughts when it comes to NFTs, especially when it comes to the music space.
Joining us now is Piali Aditya, Chief Strategy Officer at Republic, joining us on the phone from New York City. Piali, I want to start with just the most basic of questions because, and I think you know what's coming, there's still so much confusion about this space. Explain NFTs for people who, haven't bought their non-fungible tokens yet.
Hey guys, thank you for having me, and happy to start there. NFT stands for non-fungible token, and the easiest way to think about that is fungible means interchangeable. Therefore, a non-fungible token is basically a digital asset that's exclusive. It can't be replaced or swapped with something else. So each token represents a unique digital or physical asset, whereas when you think of fiat currency like the US dollar, or you think of cryptocurrency like Bitcoin, those are fungible, meaning you could trade one for another. So if you, Carol, send Tim $1 and he sends you $1 back, it doesn't have to be the same exact dollar versus any US dollar out there in circulation. They are interchangeable. But NFTs are truly one of a kind. They're authenticated on the blockchain and come with unique identification codes.
So when it comes to something like music, how do we need to think about it in the possible application of NFTs?
Yeah, so music investing for Republic is the latest step really in our mission to empower individuals to invest in the future they believe in. So we have partnerships and relationships in the music industry, and we're connecting a diverse group of musicians across genres to the people who truly enable their success. That's their fans, right? Music financing on Republic enables those artists to list their work on our platform and raise capital from their fans directly. And what's even more exciting is the fans don't have to be accredited investors. It's open to everyone.
Is this like crowdfunding for the music or for music performers? And we're not talking about the Taylor Swifts of the world, but those starting out. Because you're really a startup investor, right? You understand the beginning and how important capital is at the early stages, the angel stage.
Well, that's where we started. So Republic today, that was Republic 5 years ago. But Republic today is an investment firm that allows anyone to invest in private markets regardless of their net worth. We operate a retail investment platform open to anyone, including the college student who wants to invest with as little as $50. We have a private capital division that's open to accredited only investors, and a blockchain division, which includes an incubator and a fund. So we've grown into this tremendous ecosystem that has 700 million investments and supported over 400 companies and a growing community of 1 million plus users in 100 countries.
Well, explain, because you mentioned accredited investors a couple times. Explain from a regulatory perspective how you're able to allow non-accredited investors to make these types of investments.
Yeah, so unfortunately, these types of investments weren't available to the average individual. In fact, most Americans were kept out of private investing. But over 5 years ago, Title III legislation of the Jobs Act opened up startup investing to that 92% of Americans who are non-accredited investors. And non-accredited investors are individuals who make less than $200,000 a year or have a net worth of less than $1 million. And through the Jobs Act, the Security and Exchange Commission, the SEC, opened up registration to approve online platforms like Republic to legally raise capital for companies through equity crowdfunding.
So, and just to go back to what I was asking though, but is it an opportunity, the platform, to provide maybe musicians who are earlier in their career phase to access capital in terms of developing their work and so on? Is that kind of part of the plan or part of the intention?
Oh, it certainly is part of our plan. We are working with musicians that have 25 million streams, monthly streams on Spotify, and those that have a couple of 100,000. So it is a way for musicians of all stages to really think about raising from their fans.
It still seems like to me one barrier or one hurdle that this has to really get over, that has to get past, is education. Because I think there's still so much confusion about what this marketplace is, what the space means. How do you do that? How do you communicate that to potential customers?
Yeah, so on republic.co, we have a whole section about investing, and we're very focused on having a diversified portfolio approach. All of our offerings actually have deal pages that give a lot of information about the industry, the future potential for anyone that's raising for us. And music in itself is so unique in that what we're offering today is like all the offerings will be unique, but when you invest in music through Republic, you're typically buying equity into a company that owns the master rights for a song, an album, or equivalent. And in some of our offerings, that ownership interest may come in the form of an NFT, which we talked about earlier, or what we term a security NFT.
Hey, listen, we've got to run, but hopefully we can continue this conversation in the future. Piali Adatia, she's Chief Strategy Officer at Republic, spent half a decade working in the VC world, has had senior operating roles at Shop Your Way and also at Donna Karan, so really knows her way about this world, and especially when it comes to early investing. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So there's a series on, is it Netflix? Billions?
Yeah, no, it's Showtime.
Oh, it's Showtime, that's right. And then there's a book. Trillions.
There's a book, Trillions.
Yeah, it's all about indexing.
Yeah, Robin Wigglesworth wrote it, and Robin's going to join us in just a few minutes to talk about how a band of Wall Street renegades invented the index fund and changed finance
Could
forever.
be a Showtime series, perhaps.
It's what comes after Billions, so Trillions.
All right, we're going to get to him in just a moment. First up, though, Charlie Pellet waiting patiently, or not.
Here's what's going on. We have got the Dow lower today. Little change there, down half a point. Look like we might see a higher close today in those final couple of minutes heading into the closing bell. But in the end, down day for the Dow, up day for the S&P, up day for NASDAQ. Tech shares climbed amid lower Treasury yields after data showing inflation's running hot. Lifted companies seen as better equipped to pass on higher costs to consumers without harming their businesses. Traders are also assessing minutes of the Fed's latest policy meeting. Earnings season is here. JP Morgan's deal makers posted their best quarter yet, riding what's on track to be a record year for mergers and acquisitions. Still, shares fell today as consumer and commercial loan growth remained challenged. JP Morgan Chase lower by 2.6%. J.J. Kinahan is with TD Ameritrade. He was our guest right here on Bloomberg Business Week.
A lot of expectations, tough to meet those expectations, but the tone of their earnings calls, pretty positive overall, and the growth continues, but at a slower pace.
And Liz Ann Saunders, chief investment strategist at Charles Schwab, has this advice for investors.
If you're a stock picker, you want to be focused on quality. I think quality is going to reign in terms of leadership in these very uncertain times. I also think you really want to take advantage of the discipline of rebalancing, given the massive leadership rotational swings that we're seeing. I think that is probably the most beneficial discipline right now that investors can employ in what is a much trickier market environment.
S&P today up by 0.3%. The Dow virtually flat on the day, down half a point. NASDAQ up 0.7, 10-year yield 1.54%. Gold up 1.9%. West Texas Intermediate crude down 0.1%. American Express and other credit card issuers tumbled as JP Morgan Chase attributed weakness in its card business to rising costs on marketing and promotions. Today, American Express down 3.5%. Capital One Financial lower by 3.3%, Synchrony down 2.6%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. So we are living in an $11 trillion index frenzy. Some say it's money management on autopilot with dumb cash blindly chasing companies on the way up and down. Others say it's lower no fees and transparency that make it the better bet. But either way, it's big business.
It is. Robin Wigglesworth is global finance correspondent at the Financial Times, and he joins us now on the phone from Norway. He's also the author of the new book, Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. Robin, it's great to have you on the show. Start off by just giving us a quick idea of how big the index fund industry has grown in just a really short time when you think about markets.
Well, thanks for having me on, first of all. It's colossal. The only way of describing it. You said the 11 trillion that we know about in the US, it's increasing by almost $1 trillion a year. But if you throw in the global index fund universe, we're talking $17, $18 trillion globally. And that's actually only the actual formal funds that we know about. If you include in-house strategies, index tracking strategies at places like sovereign wealth funds, a lot of big pension plans, insurance companies will do this in-house as well. We're talking, I estimate, based on sort of cobbling together various data sources, but $26 trillion globally. So that's both bonds and stocks, of course, but it's just a huge number. That's twice as big as the combined hedge fund, private equity, and venture capital industries put together.
Yeah, and now you can count Harry and Meghan because they're building their own index as well in the ESG space. We just talked about that story earlier. You know, Robin, I got to say, I began my business broadcast career at Financial News Network. I produced 2 mutual fund shows. they were what the world was about. And at that point, a lot of funds had fees, it was strategies, it was categories. It was all about the active fund manager making the call. What happened to get us to a world today where there are now, as you say, 26 trillion globally in index funds?
Well, I mean, if we turn the clock back to, let's say, the 60s, because, I mean, for a long period, whenever there was a big downturn, let's say the Great Depression, the big crash, then people were disappointed with how their professional money managers did. There was lots of scandals around investment trusts after 1929, for example. But broadly speaking, people didn't really know what the overall stock market did. We just couldn't calculate that. We had indices like the Dow Jones Industrial Average, but not really historical data for the entire stock market. So first of all, you just didn't know what stocks did in the long run. So you didn't know how well your fund manager did against them. And you couldn't really buy the market average anyway, which was always the refrain. In the 60s, the computer finally emerged on Wall Street, but maybe more importantly, at certain economics departments. There was this sudden fount of academic research into what the stock market yielded. Ironically, first, the biggest study done in 1964 by the University of Chicago by a really eccentric professor called Jim Laurie was financed by Merrill. Merrill Lynch at the time wanted to sell stocks to ordinary people and say that they stocks return more than bonds in the long run. But the SEC said, no, you can't do that unless you prove that stocks do better than bonds in the long run. So that was the genesis. And once they had this result, it was called CRSP, Center for Research for Security Crisis, they could actually show that actually active managers did a poor job. And that's sort of the origin moment where all the index funds started flowing out because people realized actually the average active manager does badly.
So, Robin, I want to chat with you about how this has been on net a really good thing for investors, and then we're going to come back with you in a few minutes and talk more about how it could be not so good at the same time. So I want to start with why it's been so great for the average investor.
Well, it's costs. I mean, Jack Bogle, who ran one of the biggest investment groups in the world and based largely on indexing, he wasn't a big fan of the efficient market hypothesis, but he said he was a big fan of the cost matter hypothesis. And broadly speaking, for long-term savers, costs compound as well, just like returns. And in the 20, 30, 40-year savings period, the difference between paying, let's say, 4 basis points to Vanguard or 1 or 2% to an active manager is monumental. So I've seen S&P's done some research, and they calculate it's $375 billion saved by U.S. investors just over the past 20, 30 years. And that's just the direct savings, even setting aside the fact that there's a performance advantage in active in the long run. And indirectly, the average cost of a mutual fund, and even hedge funds, has fallen by a third over the past 3 decades.
Right.
And that is to a large extent because of the competitive pressures from index funds.
Hey, Robin, hang on for a second. We're going to do a little bit of news, but we're going to come back and continue with you. We are talking with Robin Wigglesworth, global finance correspondent at Financial Times. His book out is all entitled Trillions.
In the meantime, let's get a check of the latest world and national news. Nancy Lyons is standing by. Hey there, Nance.
Hey, Tim. President Biden is promoting a series of steps to improve the shipment of imported parts that have interrupted supply chains for American manufacturers and retailers.
Administration staff has been pressing companies and unions, the president said, to agree to such steps as keeping the huge ports of Los Angeles and Long Beach open for business 24 hours a day.
That will almost double the number of hours that the port is open for business, and more than that. The night hours are critical for increasing the movement of goods because highways are less crowded at night. The commitments being made today are a sign of major progress in moving goods from manufacturers to a store or to your front door.
The president said that major retailers also agreed to working nights and weekends, as did FedEx and UPS. In Washington, Irv Chapman, Bloomberg Radio.
The FDA is out with new guidelines on the amount of salt in the food we eat. The suggestion now is to lower intake from the average of 3,400 milligrams a day down to 2,300 milligrams. White House Press Secretary Jen Psaki says it is a push to get healthy.
On average, Americans consume 50% more sodium than recommended, which is linked to high blood pressure and increased risk of heart disease and stroke. And we believe that today's action will lead to a 12% reduction in average sodium intake over the next 2.5 years.
Psaki says the push is also to see salt reduction at restaurants, cafeterias, and food trucks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic in our Interactive Brokers studio. There's a story that we wanted to bring to your attention. It's by our Simone Sylvan, and it's on the Bloomberg and at Bloomberg.com. And it says, just a reminder, for many Americans, COVID lockdowns with nowhere to go and nothing to do were a time to save. But for almost 20% of U.S. households, almost 20% of U.S. households, the pandemic wiped out their entire financial cushion. This is according to a poll that was just released yesterday.
The share of respondents who said they lost all of their savings jumped to 30% for those making less than $50,000 a year. This poll came from NPR, the Robert Wood Johnson Foundation, and the Harvard T.H. Chan School of Public Health. Black and Latino households were also hit harder. The researchers surveyed a nationally representative sample of more than 3,600 U.S. adults ages 18 and older. Carol, we've talked so much throughout the pandemic about the way that this has affected different people in different ways, and the chasm between the haves and the have-nots when it comes to the economic effects.
It ties so much into, too, the bank earnings that are coming out. We talked earlier with Allison Williams about the credit card companies or the credit card part of their business, in that people have been paying down credit card debt. Their household wealth has increased. The household balance sheets are doing much better. And so as a result, they may be spending, but they're also paying down their debt. And that's been a little bit problematic in terms of fees to some of the big bank companies, something we're watching as they report earnings.
But a good thing, right?
It's a good thing, but this story reminds you that has not been the case for everyone. And once again, it gets back to that bigger, broader theme of inequities.
Right, about 2/3 of people who were surveyed by this said they received financial assistance from the government in the past few months, but 44% of them, Carol, said those programs only, quote, helped a little.
Yeah, exactly. One of the individuals involved with this survey, a VP over at the Robert Wood Johnson Foundation, saying the safety net always had holes. The pandemic ripped those holes even wider. We know lawmakers in Congress are currently debating how to spend and how much to spend on shoring up the safety net going forward. This is something that is being debated, as we know, and contested in D.C. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Turned out to be a mixed Wednesday, a Fed Wednesday no less. Traders were assessing minutes of the Federal Reserve's latest policy meeting, with officials broadly agreeing that they should start reducing stimulus in mid-November or mid-December amid increasing concern over inflation. S&P advanced 13 points today, up by 0.3%. The Dow spent a lot of the session swinging between gains and losses. By the time the closing bell clanged on Wall Street, it was a down day for the Dow, dropping by 0.5 point. Little change there. NASDAQ up 105, up 0.7. 10-year up 11/32. 10-year yield 1.53%. Spot gold now at $17.92 the ounce, up 1.9% today. We saw Bitcoin rally 2.6%, 56,844 on Bitcoin. Crude a retreat there, down 0.1%. Lower little changed at $80.57 a barrel. Delta Airlines logged the steepest drop in the S&P 500 and its biggest one-day decline in a year, after warning that rising fuel costs will threaten earnings this quarter. Today, Delta down 5.8%. Speaking of earnings, more banks tomorrow. Citigroup, Wells Fargo, and Bank of America all on tap. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. I want to get right back to Robin Wigglesworth, global finance correspondent for the Financial Times, also the author of the new book, Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. Robin joins us once again on the phone from Norway. Robin, you talked about the positive attributes of this truly revolution when it comes to individual investors and access that they have had in the past few decades to the markets. But I also wonder about the big three index fund providers, Vanguard, BlackRock, and State Street. They now manage nearly $20 trillion. That's about a quarter of all shareholder votes cast in the U.S. Do you see that as troubling?
I do, a little bit. I mean, broadly speaking, this is an oligopoly that benefits us. That the economies of scale involved with indexing and asset management are huge, and generally speaking, the benefits have fallen to us, the consumers. But I don't think it's particularly wise that we have this emerging oligopoly in the investment industry, driven by the economics of scale of indexing. And it's not just where we are today, where we're going to be in the next 10, 20 years. Like you say, the big three of index providers already cast around a quarter of all votes on average in S&P 500 companies. But I've seen academic studies that say that'll be 40, even 50% within the next 2 decades. And that was something that even Jack Bogle, who founded Vanguard, was worried about before he passed away.
So who gets hurt in this then, this process?
Well, no one gets hurt per se, at least not directly. But asset managers are under immense pressure to take stronger stances on a whole host of issues. But these are issues that, quite often are sensitive political public policy areas. And, I think reasonable people can disagree, but I don't think that crucial public policy issues should be subordinated to private sector companies, investment companies. These are issues that, for example, in the U.S., that Congress needs to wrestle with, not BlackRock and Vanguard. And as these companies become so powerful that they exert de facto control over almost every major listed company in the U.S. eventually, then they're going to be faced with lobbying on both sides. You can see them taking hits from both sides. And I have some sympathy with them, but they don't want to be in that position. But it is a natural result of how they grow. And even when they decide not to do something, that is a decision that has consequences. So I think it's the one issue that they cannot duck in the coming decade.
Hey, Robin, I'm reminded during our conversation of a story that I read in The Atlantic a few months ago by Annie Lowry, who wrote that the question, could index funds be worse than Marxism? She writes that with index funds, nobody's behind the scenes dumping bad investments and selecting good ones. Nobody's making a bet on shorting Tesla or going long on Apple. Nobody's hedging Europe and plowing money into Vietnam. Again, that's from Annie Lowry's story in The Atlantic back in April. What would you say to criticism from people who say, wait a second, with this rise of passive investing, we're not going to see the stock movements that are necessary for an efficient market?
Well, less worried about that point of criticism. I mean, first of all, that's been around since the 1970s. I found letters in the Wall Street Journal in the mid-70s complaining exactly that. Lo and behold, there are more portfolio managers, more hedge fund managers than ever before. I mean, there still are more hedge fund managers than there are Taco Bell managers in the U.S. So the idea that that active management is dying and markets becoming less efficient, I find factual. I definitely see areas where the rise of impact index funds is having a huge impact on individual stocks and potentially on the market as a whole. But is that any more malign than any shift in the ecosystem? I mean, when mutual funds were first invented, when they first started growing in the 30s and 40s, people were petrified about the same thing then. When hedge funds came about, markets always have these bogeymen, and today index funds are it. On the point that they are worse than Marxism, that is a point of criticism specifically on how much of the stock market they might own. And is that having dampening impact on the competitiveness of the U.S. economy or the global economy? That if you are a company A making widgets, but you know your biggest shareholder is also the biggest shareholder in your biggest competitor, does that have some sort of subliminal dampening effect on your urge to compete aggressively? And that it's called the common ownership theory. And that is also something that, the FTC has been looking at, the FTC is debating. I don't think they're going to get anywhere because this isn't overt anti-competitive stuff. It's just a theory at the moment, but it's definitely something that is rising up the agenda, I think, as well.
Passive bond, passive equity, there are so many different types of index funds, and I kind of laughed, especially when it comes to the ETF world. I used to laugh with my producers, like, oh, okay, here's another ETF. Like, people just create indexes for whatever they want. Is there some part of the market that you think, Robin, works more efficiently than another part? Or do you have an overwhelming thesis about it all after having done this book?
Yeah, I mean, that's a great question. I'm torn on this because, on one hand, I don't want to be some statist that says that, people should decide what you're allowed to buy. If there's a market for it, if somebody's willing to buy it, then you can produce that product within reason. But clearly there is stuff happening in the index fund world that is, just dumb. Like, people are creating dumb products that have basically zero economic and possibly negative economic value for end investors. Whether they're designed as trading tools or putting increasingly convoluted strategies and wrapping them up in an ETF, some of that stuff I think is unwise. But who am I to say that they shouldn't be allowed to do it? But I would say that most investors overall should stick to the boring, plain vanilla, broad market cap-based index funds in both equities and bonds, arguably, because the data is pretty unequivocal. They do well over time. You save a lot of money on costs. And it's kind of nice that investing is one of those few areas of life that actually pays to be a little bit lazy. Right?
Exactly. Hallelujah. Great book, great topic, no doubt about it. It's called Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. Our thanks to Robin Wigglesworth. Robin Wigglesworth. He's global finance correspondent at the Financial Times.
Joining us from Oslo.
Yeah. Neat stuff. What? What do you
Beautiful city. Jealous.
Yeah.
Get back to Norway.
You don't like being here with me?
I do, but I mean...
In this lovely studio in New York City?
Let's do a show from Norway.
I'm going to take that as a no. Folks, we got more bank earnings, a slew of them coming tomorrow. We'll be breaking them down. You ready for that?
I'm ready.
Stenovic, who'd rather be in Oslo?
No, I'm here this week, okay?
For the whole Business Week team, have a good and safe evening.